Hello, everybody. Welcome to this managerial accounting course, which is also referred to as management accounting. And I'm very sure you'll absolutely love this course. I have structured this in a very efficient manner, and everything will be very clear, and everything that I will teach is what you need to know. So let's jump directly into it. First concept that you should always learn in managerial accounting is what is managerial accounting? Like, what are we learning here? So I would encourage you to think of managerial accounting as a accounting that helps managers make better decisions, right? That is like a very good way of thinking about it. Accounting that helps managers make better decisions. Now, what does that actually mean? Because it is not clear with that definition. Like, it's so vague, helps manager make better decisions. So, because managers are required to make decisions about a lot of different aspects of the business. So, managerial accounting, we learn how to make good decisions in all of the different areas that managers have to uh, make decisions in. So, so once now that we have cleared out what managerial accounting means, let's jump directly into the topics. So first topic I will encourage you to know about is called manufacturing costs. This is extremely important to understand correctly. So manufacturing costs. So remember, in a manufacturing company, there are just three manufacturing costs. Okay, there's direct material. We'll explain what that is. There's something called direct labor, and the last one is called factory overheads or production overheads. So I will just write in this case manufacturing overhead, because there are so many names for this, 4 or 5 different names. Okay, so let's explain what each of these costs refer to. So direct material refers to the material used to make the product. For example, if I ask you what is the direct material of making a laptop, you will say a keyboard, a screen, processor, RAM, right? All of these things that you'll put together to make the laptop. Similarly, when we talk about direct labor, we are talking about the labor which are assembling the product. Okay, so labor that are assembling the product means they are directly involved in making the product come together and work as a unit. Now you might say, what if they're using machines? Of course, nowadays everybody uses machines to make products, right? So yes, the same thing applies, because people need to operate the machines. The people who are operating the machine to assemble the laptop, those are the direct labor. So after that, now we have the last term, which is the term that most people don't really understand. They have like different definitions, and they never really get to the correct way of thinking about it. So I will give you the easiest and the best way to think about it. Think of manufacturing overhead as all of the factory related costs other than direct material and direct labor. So that's a very good way to think about it, because please understand that when you have a manufacturing business, you have the factory where you make the products, and then you have the office, right? So we are saying all of the factory costs that you're paying, the factory rent, factory electricity, factory, let's say, supervisor, factory depreciation, all of the costs that you're incurring in the factory, except the direct material and direct labor, are manufacturing overhead. So in this case, let me write some examples for you. So this will be factory rent, or rather than saying factory depreciation, you can just say like equipment depreciation in the factory, and like all of these other factory related costs. Like, just like that's the best way to think about it. If it's a factory cost, and if it is not direct material labor, it is automatically considered a overhead. Now that we've talked about the three manufacturing costs, please understand that when you're making a product, these are the only things you need, right? You need the material, you need the labor, and you need the overheads, place where you're actually making the product. And that's practically like what manufacturing cost means. Now, I do want you to be familiar with some terms that we also use for manufacturing costs. So if you're given an exam, you don't get confused with like, oh, what does that word mean, right? You already have an idea. So please understand that manufacturing cost is also called product cost, which should make sense because manufacturing cost is a cost to make a product. Product cost is exactly as the name suggests, like the same, literally the same thing. And obviously, you might be thinking, what about the non-manufacturing cost? Non-manufacturing costs are any cost that is not a manufacturing cost. That's one way to think about it. Or any office-related costs. You know, there are many ways to think about non-manufacturing costs, but these are very obvious usually. These are like any cost that is not a manufacturing cost. And now another term that you can also see for non-manufacturing cost is called the period cost. So just to make sure we understand this, manufacturing costs are also called product cost, and non-manufacturing costs are also referred to as period costs. So that's it for the manufacturing costs. So now let's talk about some cost terms. So first of all, I would like for you to know the difference between variable cost and fixed cost. So let's define both of these. So variable cost is any cost that changes with the level of production. Now, to make this journey very easy for you of managerial accounting, just remember two examples of these. Like these two examples should always be on the front of your mind. The first example is direct material. Think about it. If I want to make more laptops, I need more screens, which is some direct material of the laptop, and more keyboards and more RAM and so on. And also direct labor is a variable cost, because if I need to make more laptops, I need my labor to work more. Now you might be thinking, what if they are paid by salaries? But you have to understand, usually we don't pay the labor that are assembling the product, the direct labor, based on salary. We pay them based on wages, means per hour basis. So if you are going to make more laptops, they need to work more, and that means you need to pay them more. So those are the two examples I would like you to know for variable cost. And let's talk about something called the fixed cost. Now, fixed cost is any cost that does not change with the level of production. Now, what are the examples of this one? There are three examples I will encourage you to remember. So, rent, depreciation, and the last one is salaries. Why these three terms? Because in my experience of teaching, these are the most common examples you see in questions, right? So I would really like for you to know all of the most common things, so you're like very quick in pattern recognition. Okay, this is always a fixed cost, so it becomes a bit easier for you to solve questions. Okay, so now let's talk about prime cost versus conversion cost. What do these terms mean? So for prime cost, I would say just think of it as this formula. Prime cost just means direct material plus direct labor. Now, if you have been in any of my previous courses, you know, like I don't want you to know anything extra than you're supposed to know. So for prime cost, just remember the formula. You don't need to know more than that, right? So we are going to be very efficient with our time here. And then there's something called conversion cost. Here I would say some more things than what I did for prime cost. So conversion cost is basically direct labor plus factory overhead or manufacturing overhead, whatever name you can you want to use for that. Now let me explain why the direct labor and manufacturing overhead are called conversion cost. Because when you are a manufacturing company, you buy the raw material and now you use the labor, means people who are like going to work on the material, and the factory machines and everything to convert the raw material into a finished product, right? That's why it's called conversion cost. The labor cost and the overhead cost are called conversion costs. So that's basically all you need to know about prime cost and conversion cost. Now I am going to talk about some very helpful things you should know in managerial accounting, and these are the things, not the normally teachers don't tell students, but in my teaching experience this is extremely helpful to know. So what am I going to talk about here? So the thing is, when you're calculating the manufacturing cost, there are some facts you should always know that you will be tested. So when you're finding the manufacturing cost, we already established that there are three manufacturing costs: direct material, direct labor, and manufacturing overhead. So in a question, if you're supposed to find the total manufacturing cost, means material, direct material plus direct labor plus the overhead, you would need to know all of the three numbers. But the thing is, you should always know, when you are a company or any business, it's very easy for us to know the direct material we're using. Because we're using, like, let's say, for example, if I'm making a table and I know I used, let's say, 2 feet of wood in the table, I can just multiply that by per feet rate and I find the direct material cost. It's not difficult. That's why when you're giving an exam, direct material is always provided in the question. You don't have to find it. Similarly, the same for direct labor. When you're making a product, you can see that it is taking you 2 hours to make the product. And then you can multiply 2 hours by the rate to find the cost it took you. So that's why direct labor is also given in the managerial accounting questions that you'll see in the exam. The only thing that we never directly know how much we are using is the manufacturing overhead, which is why I'm making this video. So you should always be aware, direct material will be given, direct labor will be given, the overhead is the only one you should always know how to find. That's it. So let's get right into that. So how to find the manufacturing overhead. So first, memorize this two-step structure. So step 1 will always be to find the rate. What do I mean by the rate? Let me explain. So calculate the predetermined overhead rate. So the formula is basically budgeted total overhead divided by budgeted total allocation base, which is usually direct labor hours or machine hours. Budgeted allocation base. Now just to explain what the budgeted means. Budgeted means estimated, okay? Because we do this calculation of the rate at the start of a accounting period. So of course we don't know the actual overhead. We can only estimate the overhead that is going to happen in total. And it's not as difficult as you might think that it would be, because most of the overhead costs are fixed: salaries, rent, depreciation. So it is actually not that difficult to do. But again, if you're a student, it will be given in the question. So easy for you, I guess. And divided by budget allocation base. Allocation base is what thing we will use to distribute the overhead into each product. So again, like I said, usually the rate is calculated based on direct labor hours or machine hours. Again, the question will tell you overhead is calculated based on machine hours. So you'll divide it by the machine hours. So it will be easy. When we get to that, I'll show you. So once you find the rate, step 2 is multiply the predetermined overhead rate, POHR, right, with the allocation base actually used for the product. Now, just to give you more of an explanation why we need to do this overhead calculation, because let's say I have a business of making furniture and I made a table for one of my customers, right? Now there's no way I can like say this much of the factory rent was used on the table, because it's not a direct cost, right? I cannot directly trace it back to the table. Rent is like I pay for the month, right? So it's not directly attributable to the products. So that's why we have to, when we talk about overheads, because overheads are not directly attributable to the products, we have to use this two-step approach to allocate the cost. At the moment, you might be thinking like, what does this mean? What did we just learn here? I just want you to know the structure of how to find the overhead, because when you're solving manufacturing cost question, the students get confused, right? Like how should I start the question? You should start the question by knowing already that direct material will already be given, direct labor will already be given. I just have to find the manufacturing overhead, which I can find with 2 steps. So now you already know what you need to look for. First step, I need to find this number and this number so I can find the rate. And then second, I need to do this. So this actually makes life a lot easier. Now, obviously, we'll solve a question for this. So let's solve this question. This looks like a very reasonable question, and it will give you the value that I want you to give you out of this question. So please pause the video and read the question, and so I can basically show you how to find the overhead rate, which we already talked about. When you want to find the overhead, first you need to calculate the overhead rate, and the second step is multiply the overhead rate with the allocation base we actually used for the product. So that's kind of what I want to show you in this question. So part number A is just asking the overhead rate. So to solve that, we will copy the formula we already wrote. There you go. So budgeted manufacturing overhead means what was the estimated manufacturing overhead for the year. So they are saying we have used machine hours are expected to be 305,000. Expected means this is what was estimated to happen, divided by budgeted allocation base. I said that the allocation base is like what will we use to distribute the overhead into the products. So usually it's labor hours or machine hours. So in this case, we have the machine usage is estimated at 125,000. So I hope you're noticing I did not use the actual data, like I did not use what actually happened in overhead and what actually we used in hours. I used the budgeted data, the estimated data. Okay, so if I solve this, I will find the rate of 2.44. Always make a habit out of writing a meaning of this. This means I'm spending $2.44 per machine hour. Always write the meaning of the rate. This is a great habit to have. This will help you solve a lot of questions, because the number now makes sense. Now we know for every 1 machine hour we use, we will be spending $2.44 in overheads. Okay, that's what the rate is telling you in this case. Now, if I want to find out how much overhead I actually used on a product. So in this case, let's say this business makes whatever product they are making. So let's find how much overhead they actually use applied to the product. So what was the second step? To know the overhead, multiply the rate with the allocation base actually used for the product. So in this case, we don't have like separate products, we just have like single data. We can assume this is like they are making one product. So 2.44 times what did they actually use in hours? 130,000. So 2.44 times 130,000, and this is called applied manufacturing overhead. And please remember, when your teacher asks you to solve a question to find the overhead, you have to find the applied overhead to find how much you used on that product. It doesn't matter what the actual was, you only have to find the applied overhead. Please keep that in mind. That's why I'm telling you 2-step way, and I'm repeating this again and again from my experience. I know these are the terms that actually make it a problem to understand managerial accounting. So just to say it one more time, when you're using this 2-step way to find the overhead, because you'll always have to use the 2-step way to find the overhead, you're not finding the actual manufacturing overhead, you're finding the applied manufacturing overhead. Okay, actual is going to be different than that. So in our question, what is the actual overhead that happened? 322,000. So if I write here 322,000, this is the actual manufacturing overhead. Now I can see, okay, the amount of overhead I actually was able to apply was actually less than what actually happened. So I have to calculate this, how much overhead I applied less than what actually happened. So this is called under applied overhead. So for now, that is a very good like a question for you to understand what's going on. So if we need to find the overhead we are using on a certain product, in this case we don't have different products, we just have like a company that probably is making just the same product. We will use this two-step way to find the overhead, which we'll do in every other question as well. It's always a two-step way to find the overhead you're using for the product. But the overhead you'll find it will not be the actual overhead. The overhead you'll be find will be called applied overhead. So, and by the way, applied overhead is what we need. Just to let you know, to find the total manufacturing cost, we want the applied overhead. And once you find the applied overhead, you can compare it with the actual overhead, what actually happened, and see if it was under applied or over applied than actual. So let's start a costing method, first one, which is called job costing. So to understand job costing, first you have to understand what do we mean by a job in managerial accounting. So think of job as a order. For example, McDonald's. McDonald's get a lot of orders every day, right? Like when they open their place, every day, like so many customers are placing in their order. I want this Big Mac. I want this and with this. I want this, that, with that. So these are called jobs for McDonald's, means orders for McDonald's. That's what we mean by job costing, means to calculate the cost of each order we are preparing. So from that, you might have gotten an idea that job costing, if it is based on each order separately, it has to be for businesses that provide different order arrangements, right? It cannot be for a business that sells the same product to everyone, you know. So Coca-Cola cannot use job costing because they sell the same Coca-Cola to everyone. It's not like custom made. But however, when you're talking about McDonald's, of course they use job costing because they don't give the same order to everyone. It's like based on what you're ordering, you get to give the money. Okay, now if we talk about, let's say, a furniture shop, and the furniture shops usually, you know, like they can get orders. I want this type of table, I want this type of a door, I want this type of a sofa, right? So now this furniture shopkeeper has to quote them the price. To be able to quote a price to the customer, you need to know the cost. That's called job costing. We need to find the cost of that order, so we can add our profit margin and then tell the price. So job costing means calculating the cost of a job. Just keep that in mind. When we are doing job costing, we are calculating the cost of a specific order, cost of a specific job. Okay. So now let me quickly make a question here so you can see like how we solve a job costing question. Okay, so let's say ABC Limited has a business of manufacturing and selling furniture, for example. They have provided the following information about two jobs that they have. So let's say they have a job 1 from one customer and job 2 from another customer. So obviously they will tell you the direct material they think they will use on the job, because we already talked about this. You always know how much material you're going to use on something. Direct material is easily traceable, so it's not a problem. So let's assume the material we'll use on job 1 is $4,000 worth and job 2 it is $3,500 worth. Okay. Direct labor, another direct cost, another thing that will be given in the questions. Let's say we use $1,000 in labor here and apparently $1,400 of labor here. But the problem will be we will not be provided the manufacturing overhead, because we talked about this. That is the part we have to master, how to find the overhead of any costing system. So in this case, the question will give some this type of data, which you already know what that is given for. So budgeted total overhead will be given. Total overhead. Let's assume for the full year, the furniture shop is estimating overhead to be $100,000. and let's say they use the machine hours as allocation base, or okay, here we can even say labor hours. So let's say budgeted direct labor hours, direct labor hours. So let's assume that's the allocation base. So let's say they were thinking in total this year they will use 10,000 direct labor hours. Okay. Now you will be given one other information, because to find overhead I need to know how much hours I used on each job, right? So I can distribute the money based on the hours. So you will be provided something like this, direct labor hours. So let's say in job 1 we will be using 10 hours, and in job 2 we will be using 12 hours. Okay, now the question will ask you, calculate the manufacturing overhead for each job, and then once you find that, calculate the total manufacturing cost for each job. Now, how do we do this? Again, always remember, whenever we are supposed to find the manufacturing overhead, it's always a two-step process, right? First step is to find the rate. Second step is to multiply the rate by how much allocation base, means in this case hours, we actually used on the job. So let me show you how to do that. So manufacturing overhead calculation. First we'll find predetermined overhead rate. Predetermined overhead rate. It's called predetermined because we calculate this at the end, at the start of the year. So whenever the year happens. So the formula we already know, it's the budgeted overhead divided by budgeted allocation base, in this case which is labor hours. So budgeted overhead is 100,000 divided by budgeted allocation base, which is labor hours, so $10,000. So now we have found out that per labor hour we are using $10 of overhead. Now we can easily find for each job how much overhead we used, because for let's assume I'm doing job number 1. I can do 10, which is per hour rate, times how many hours I actually used on the job, 10. So that means job 1 used $100 in overheads, and job 2 will be 10 per hour multiplied by 12, because we used 12 hours on this job. So this will be $120, and now we have found the overhead for each job. So once you know the overheads, now we can calculate the total manufacturing cost of each job. So let's do here job 1, job 2. So we have direct material, direct labor, and manufacturing overhead. So direct material, direct labor, you can just copy from the question because we know conceptually it will always be given. But the overhead is what we have to put from our calculation. Overhead for job 1 was this, and job 2 was this number. And now if we do the totals, we will find the total manufacturing cost of each job. So let me do the total. So 4,000 plus 1,000 plus 100. And for this one, 3,500 plus 1,400 plus 120. So that's how you solve the question of job costing to find the total manufacturing cost. So again, the purpose is so now I can give the accurate price to the customer, right? Once I know how much it will cost me to complete the job, I can add some profit and then quote the price. Here we already discussed the job costing, and I want to also define some other things. So the manager accounting is a no-brainer. It becomes quite a bit easier for you to go through concepts. So we did job costing. Let me open where we learned the manufacturing overhead. So we said when you have the 3 manufacturing costs, of course, we have direct material, direct labor, and overhead. Only the overhead is the problematic part to find out how much we're using on making a product, right? Because it's very difficult to say like I use this much of rent to make this product. It's really difficult to say that. So that's why when we're trying to find the overhead, we use 2-step way. First we find the predetermined overhead rate, and then we multiply it by the allocation base actually used. So we obviously saw that in the real question. So we found the rate, and then we multiplied the rate with allocation base actually used. So what I wanted to talk about here is when we find a single rate, which is what we did, right? Predetermined overhead rate. This is called also a blanket rate. And whenever we are using a blanket rate or a single overhead rate, it is referred to as traditional costing. So you'll hear this word a lot of times in management accounting, like calculate the cost of the product using traditional costing. That means calculate the cost of the product. So you're finding the overhead based on a single overhead rate. But traditional costing is not always a very accurate way of doing accounting. Let me give you an example. If you're making one product, then traditional costing is fine. It will give you a very accurate answer. However, if you're making more than one products, now traditional costing is no longer accurate, because when we are saying overhead includes a lot of different costs. So for example, if we break down the total overhead into different costs, let's say there might be ordering cost within the overhead. There might be inspection cost within the overhead. There might be, let's say, machine setup cost within the overhead. So these are things we would be doing under the overhead. So when we are doing the single rate, we are taking the total overhead, means combination of all of these costs, and then dividing it by a single allocation base to find a single rate. However, if you're making two products, and let's say you're making product A and product B. So if my product A is only using the ordering and inspection part of, let's say, the overhead, and it's not using any machine setup. So logically speaking, the machine setup cost from the overhead should not be allocated to the product A. It should not be distributed to product A because it didn't use any, right? So that's the problem when you're making more than one products. You cannot just say let's apply a single rate and to each product. No, because not all of the products are using the same different things within the overhead. And just to let you know, these are called activities. Within the overhead, these are things we are doing. So there can be obviously more of these. There can be packaging, there can be maintenance, and all of other things that go under overhead. So I hope you saw the point, like why traditional costing is not the best when you're making more than one product. Because if you're making more than one product might use one activity and the other activity, but the other product might use all of the activities, let's say. So this means all of the 4 different costs should be allocated to product B, but only cost of ordering and machine setup should be allocated to product A. And only way we can do this is to use activity based costing, not traditional costing. So this is where we have to start the new topic called activity based costing. Means we only distribute the cost of a activity if the product uses that activity, not take the total overhead and divide it by the allocation base to find a single rate. No, we don't do that. So in the next video, we'll talk about activity based costing and how to solve that. Activity based costing. Now let me also again reiterate the idea that I said, that when you have traditional costing, we use a single overhead rate to distribute the overhead to each product. However, under activity based costing, we have to find multiple rates. That means each activity has its own rate. So when a product uses that activity, then we distribute the rate. But at the moment, if it doesn't make sense, don't worry about it. That's why we are here in this video. So let me explain some terms. First, what do we mean by an activity? So activity again means things that you are doing, like ordering, like we talked about, inspection, machine setup, packaging, maintenance, and all of the other things that go along with that. So let me copy it from where we already discussed the activities that you might see. But we also have to understand something called cost driver. What is the concept of cost driver? Now, cost driver is something that directly affects a individual cost. Now, for example, obviously we can say ordering cost is affected by the number of orders you place, right? So we can say for ordering activity, cost driver will be number of orders, because the more number of orders you place, the more ordering cost you will have to pay. If you don't place any order, then there's no ordering cost. Similarly, for inspection, if we think about it, which let's say variable drives inspection? Of course, number of inspection hours. If I do more hours of inspection, I have to pay more money in inspection. So this will be number of inspection hours. Machine setup, okay? So this will be number of machine setups. And if you don't know what machine setup means, let me explain. You don't need to know this, but I always like to go things in a very logical way. So, let's take a company like Coca-Cola, right? So what they will do is, they will make Coca-Cola, right, in a batch, and then before making the second batch of Coca-Cola, they will have to clean the machine, right? Then they can do the second batch. That cleaning of the machine to get it ready for the next batch is called machine setup. So number of machine setups is a very good way to distribute the machine setup cost. Packaging might be number of plastic meters used, number of plastics of meter used. Yeah, so like anything that logically directly relates to the cost. So here I'll say, let's say meters of plastic used. So obviously if the product is using more plastic in packaging, it should bear most of the cost. So that's the introduction to what we mean by activity and what do we mean by cost driver. Now let's break this down into what will I do in activity-based costing. So in activity-based costing, the problem is again the same that we had in traditional costing, which is direct material and direct labor, we always know what they are. Here also we will know always what they are. The problem will be how do we distribute the overhead. In the traditional costing, we find the single rate and multiply the single rate by allocation base actually used. But in activity-based costing, we calculate multiple rates. For each activity, we'll find a separate rate and then multiply each rate by their use individually. So let me show you step by step. So if I go to my, let's say, format here that I made for you in traditional costing, right? Find the single rate and then multiply single rate. But here, if I change it for activity-based costing, it will no longer be calculate the single rate. It will be calculate the activity rates. Calculate all of the activity rates. That's the first step. What do we mean by activity rate? Activity rate means take the activity cost. How much means how much money we spent on doing that specific task. Let me erase the extra line, okay, divided by the activity cost driver. So just to give you an example, this will mean the total money we spent on ordering divided by total number of orders we placed. So we can find per order cost. That's called a rate, right? Find per order cost in this case. So we have a question here relating to activity-based costing. So I will recommend pause the video and read the question entirely and then like solve with me together so you understand what's going on. So in this question, we have two products this company manufactures. They make smart speakers and wireless earbuds. And the requirement is calculate the overhead cost allocated to each product. So we have to distribute the overhead that we had to each product, how much was used by each product, and then calculate the total manufacturing cost per unit. And we know to know the total manufacturing cost, we need the direct material, direct labor, and overhead. And like I told you, always the direct material and labor is given. So in this question even, we know the per unit direct material is 50 and per unit direct labor is 20 for the smart speakers and same for the wireless earbuds. We have been provided the numbers. So without any further ado, let's start the question. So first step is always obviously to find the overhead. And how do you find the overhead? With the two steps. First step is to find the rates. So let's find the rates. I always refer to the steps so it like gives you a framework to solve a question. So doesn't matter how hard a question is, you already know what you're looking for. Okay, first step, I have to find the rates. Okay, how do I find the rate? I need the activity cost. Look there and so on. So it makes life a lot easier. So in any case, let's first do the activity rates. So first activity we have is machine setup. Okay, so we'll find the machine setup rate. The formula we already talked about is the total activity cost divided by the activity cost driver. So what is the total cost of machine setup? $100,000 divided by, let me go there, divide by, there you go. So divide by the total cost driver of this activity. In this case, the cost driver is number of setups, and it is 100 setups in total that this activity used. Okay, so if we divide this by cost driver, we are going to get the answer, which is the activity rate. Now you have to always make this a habit to write the meaning of what this means. This means we are using $1,000 per machine setup. Writing the meaning is important because it helps you clearly understand in the mind what you literally just found out. We just found out how much per machine setup costs us in overhead. So that's a good thing to know to be able to distribute the money. Okay, second activity, quality control. Okay, quality control. Same procedure. What is the cost? 120,000 divided by what is the cost driver? 600 inspection. So 600. And if I solve this here, 120 divided by 600, we found the answer 200 per inspection, because we're dividing it by number of inspections. So it is giving you how much you are spending per inspection in overhead. Okay, third one, packaging. So for packaging, it's 80,000 over 15,000. So 15,000. And again, if we solve this here, so this will be per unit, because cost driver for packaging is units in this question. So this will be 5.3 per unit we are spending in packaging. Okay, then we have the last one, which is called machining. So machining, what is the machining cost? $200,000 divided by what is the machining cost driver? 20,000 hours. So this means whatever answer we get, it is per machine hour. So first step finished. We just found out all of the rates. Now we multiply each rate by how much cost driver was used by each product. Again, if it doesn't make sense at the moment, don't worry. Once I finish this, then it will be clear, because you would have seen it with your own eyes. So step 2 is we have to now multiply. So I would recommend this approach. Write the names of the products on the columns to make it easy, right? So we are making 2 smart speakers and wireless earbuds. So we'll do smart. Let's talk about CVP analysis. So CVP analysis. Now CVP stands for cost, volume, profit. So when we're saying CVP analysis, we mean cost analysis, or volume analysis, and profit analysis. So let me mention that. So CVP stands for cost, volume, profit analysis. Now, just to give a brief introduction of what this would entail for us to cover this. Now, you have to understand that at the start of each year, managers need to plan out certain things, like, for example, how much quantity of product they should sell to make a certain amount of profit. How much quantity of product they should sell to not lose any money and not make any profit, which is called the break-even point, where you don't make a profit or a loss, right? And that is not for the sake of achieving it, it's for the sake of knowing the minimum point, you know. So if I know my break-even point, I know what is the minimum I should ever sell to avoid a loss in a certain year, because of course things happen. Let's say in COVID, if I know as a business that if I sell, let's say, 1,000 bicycles, I will break even. If I'm not able to sell more than 1,000, I will try to at least reach 1,000, so that year I avoid a net loss. And of course, you're not making a profit, but you're also not making a loss either. You're not going in the backward direction. You're staying on the same level. Okay. So first let's talk about break even. Of course, well, like we said, you managers need to know what the break even point is. Now when we're talking about break even, like we said, it basically means a point where there is zero net profit, means you're not making any profit or any loss, you're just breaking even. Now when we talk about break even, we have to talk about this in two ways. First way is we have to talk about in break even in units, means how many units I need to sell to break even. And the second way we have to talk about is called break even in dollars, means how much dollars I should earn in revenue to break even. So to find break even in units, the formula is pretty straightforward. It is fixed cost over contribution margin per unit. Now contribution margin per unit, I'll write the formula for you what that means. So contribution margin per unit means sales price per unit minus variable cost per unit. So if you use this formula, you will find how many units you need to sell to break even. I hope that's clear. Of course, we'll solve a question. So before doing a question, of course, let's define what we mean by break even in dollars. So to find break even in dollars, there are multiple ways you can do that. You can take the same units formula and then multiply it by the sales price per unit. Because of course, if I know the units and I times it by the sales price, I get the revenue, or let's say a dollar amount I should be earning. So that's one way to find it, but there's another formula you need to know for break even in dollars, which is fixed cost over contribution margin ratio. Now the question becomes, what is the contribution margin ratio? So let me give you that formula as well. I know it's getting like a lot of formulas. That's what this topic is about. It's just formulas. If you know the formulas, you are good to go. So the formula for contribution margin ratio will be contribution margin per unit, which we already discussed what that is, sales price per unit minus variable cost per unit, divided by sales price per unit. So these are the formulas. Now, of course, I will prepare a question where we will find the break even in units and break even in dollars. Let's solve this question right here. So obviously it's a break even question. Like we talked about in the last video, we learned the break even formulas. Now we're going to do a question. So a company is selling one product for $50 per unit. The variable cost per unit is $30 and the company has a fixed cost of $40,000 per year. So we have to calculate break even point in units, means of course how many units I need to sell to break even, and break even point in dollars. So for now I will copy the formulas for you because this is the first time you're learning this, so not a problem. Next time of course I will expect you to know the formulas, like when you're solving this again. Of course in the future videos I'm not going to ask you this again, but you should rewatch the videos and try to solve the questions from memory. Okay, now to do break even in units I need the fixed cost. So why don't we fill out the formula? Fixed cost will be 40,000 and we divide it by the contribution margin per unit, and we know contribution margin means sales price minus the variable cost per unit. So can I say $50 is sales price, $30 is the variable cost per unit, so contribution margin will be 20 because 50 minus 30, let me mention it here for you just so you know what I'm doing, 20. So if we solve this, we will get break even units that we need to sell to not lose any money or make a profit. So this is break even in units. Very simple. As you can see, just use the formula and you'll be fine. And then let's do break even in dollars. I hope you remember the trick I told you. If you know the units, you can just multiply the units by the sales price per unit, which is 50. It always comes in handy to know all of these quick ways to solve things. However, I also want to show you the separate way to do this as well with this its own formula, which is this one. So let's do that. with using this formula, at least so we are able to know all of the ways to solve this, at least all of the common ways, let's say. There we go. Now we have to put in the fixed cost, which of course again is 40,000, divided by contribution margin ratio. What is contribution margin ratio? Contribution margin per unit divided by sales price per unit. So if I directly solve it here, what is the contribution margin per unit? We already found out it's 20, divided by sales price per unit, which we also know is 50 according to the question. If I put this here, now if I solve this, I will get the break even in dollars, just like I got here. So if I divide this by 40, there we go. So if you can see, you get the same answer in both approaches. So use the one that is applicable to the question, because sometimes the data is given in a way that only one of these ways is possible to solve the dollars part of it. So at least now you know both of them. And one other thing I would like to mention. In some questions, when you solve the break even in units, you wouldn't get this like a very clean answer like 2000 units. It will be like a point in points, in decimals. For example, this is just an exam tip, right? Just so you know how to do this. Let's say in the exam you're solving a break even in units question, and the break even in units answer comes out as 200 and let's say 2.35. And let's say you have options, right, in the multiple choice question. Please remember, whenever we find break even in units in decimals, we always have to round up. I know mathematically, since this is below 5, we will have to round down, but not in break even topic. In CVP topic, we always have to round up. So please remember, in the exam you'll write this as 203 units. Logically speaking, the reasoning for this is, we know if I go below the break even, I will lose profit, right? I'll lose money, I will make a net loss. So to avoid that, we want to sell little bit more rather than little bit less to go into a loss. So that's basically one additional thing I want to talk about. So in the next video, we'll talk about target profit in units and how to find target profit in dollars. So let's talk about target profit in units and dollars. So target profit. Now just to explain what we mean by target profit, this is the profit you want to make in a certain year. Of course, now we just learned how to find the break even point in units and dollars. Means if I want to break even, how many units I should sell or how much dollars I should earn in revenue. But here we are now going to talk about how to find out the units you need to sell to make a certain amount of profit, or the dollars you need to earn to make a certain amount of profit. So in this case, the formulas are actually pretty similar to break even. So let me show you a magical way to know the target profit formulas automatically. So what you want to do is, you want to copy the break even formulas, okay? Because I really want to show you this trick. This will make it really very easy for you to remember the formulas. If you're a student, this is a very good way. So all you have to do is to convert the break even in units formula to the target profit formula is just add target profit in the numerator, in the top part of the formula. That's all. Now it's no longer a break even formula, it's a target profit in units formula. Target profit in units. And that's how you find the target profit that you need to make to, that's how you find like the units you need to sell to make a target profit. So I'm trying to add a row here. There we go, okay. So we are learning target profit now. So similarly in the dollars as well, if I want to convert the break-even dollars formula into the target profit in dollars formula, I just add target profit in the numerator to make this a target profit formula. Similarly, here also, I just add the target profit. And that's it. Like now it's no longer a break-even formula, it's a target profit in dollars formula. And yeah, there's nothing else to it. Like it's literally like target profit will be given in the question. This is how much money profit we want to make, and so on. So in the next video, we are going to talk about the scenario where, of course, you want to make a certain amount of profit, but there's also tax involved, you know. So now you have to figure, like, account for tax and then like figure out how much profit you need to make. So if that doesn't make sense at the moment, don't worry. In the next video, we will make everything clear. Let's talk about a situation where you obviously need to calculate the target profit, but there's also tax involved. If you're a student, you'll see this situation in questions. If you are doing this for real life, that means that is the situation you want to know, you know, because this formula doesn't really account for the taxation. It just like looks into how much profit we want to make and just subtracts the cost. But we know that taxation is not like given as a variable cost or fixed cost, because you have to calculate it based on the profit you made before tax. So let me just show you a quick way to convert the target profit formulas into target profit formulas for taxation included scenarios. So for example, I just want to make a point clear here what I mean by this. So let's say I want to make a target profit of $40,000, but the problem is I cannot make actually 40,000 in profit to get 40,000 in profit, because if I make 40,000 in profit, I will have to pay some tax out of that. Let's say in my country the tax rate is 20%, for example. So 20% of this will be 8,000. That means I will be left with 32,000 if I go for target profit of 40,000, you know. So how can we get away from this problem where whatever profit I want to make is exactly what I will make after taxes? Again, just to repeat that point, if you use the target profits normal formulas that we learned, the problem is that doesn't account for the taxation. So when I make the profit I want to make, I will have to pay tax, and then I will remain with lower profit than I wanted to have. So there's a formula I'm going to give you here, which is going to convert the let's say after tax profit we want to make into before tax profit that we can plug into the formula. So the formula goes something like this. To convert, let me write also like what it means. To convert the after tax profit, let's say that we want to make, into before tax profit, which we need to plug in the formula. So we make the before tax profit and then we pay tax, and then you're left with the money we wanted to make after all. So the formula is very simple. Formula will be, you have to divide the profit that you want to make, target profit, let's say after taxes you want to make, with 1 minus tax rate. 1 minus tax rate. So if you apply this formula, this will convert this after tax profit that you want to make into before tax, how much that would amount to, and then you plug that into the formula and you get the answer. So now we're going to obviously solve a question, so I can show you in practice. If this didn't make much sense when we solve the question, it certainly will make a lot of sense. Hello everyone, so we are back. I got a new haircut and let's get started, I guess. Okay, so this is the target profit question where there's also tax involved. So first of all, as you know, whenever there's a tax involved in the profit you are trying to make, right? Like, because let's say I want to make a after tax profit of 50,000, I first need to convert it into before tax before I can apply the target profit formulas. So that's exactly what we're going to do here. You can pause the video and read the question and we will get started. So now I'm going to assume you have read the question, so let's get started. First requirement is calculate the target profit before tax. So of course that we would have done anyways, even if that wasn't a requirement. We have to do this to find the target profit in units. So we learned a formula in the last video to find the target profit before tax from the target profit after tax. The formula was target profit before tax, after tax divided by 1 minus tax rate. Okay, so in this one, if we plug in the numbers, what is the target profit after tax we want to make? We want to make a profit of 84,000. So 84,000 divided by 1 minus tax rate. So you can say 70% because tax rate is 30% and 1 minus 30% is 70%. And if we do this, we will find an answer of $120,000. So this means to earn an after tax profit of 84,000, I need to make a target profit before tax of 120,000. Okay, so once that's clear, now that we know how much target profit before tax we need to accomplish, we can do requirement number 2, which is to calculate the number of units we need to sell to make a target profit after tax, of course, right? So we will apply the target profit formula, which is, there we go, and just plug in the numbers. Again, in the target profit place, you have to put the target profit before tax, not the after tax, otherwise you wouldn't get the right answer. I hope that's clear by now. So if we do fixed cost, which is $120,000 plus target profit before tax, which is also apparently $120,000, big coincidence here, divided by contribution margin per unit, which means sales price per unit minus variable cost per unit. That's the formula we learned for the contribution margin per unit. So if you notice, the price is 50, variable cost is 30, that obviously means contribution margin per unit is 20. So if we divide the total of the above with the below, so 240,000 divided by 20, 12,000 units. So this means if the company sells 12,000 units, they will generate an after tax profit of 84,000, which is what our goal was. Okay, next requirement is to calculate the sales revenue, means dollar number, to achieve the target profit, not the units. It's not, now we don't have to calculate how many units we should sell, we have to calculate how much dollars we need to earn in our sales revenue. So again, let's copy the question. If I hope you remember the trick, you can just multiply this by the sales price as well to get to do it quickly, but let's also do it directly with the full formula we learned without like this quick trick, right? So the full formula we learned is this one, to directly find the target profit in dollars. So the reason you need to know both formulas is sometimes one formula is applicable in a question, based on the details given. So that's why it's always good to know all of the formulas that you might end up needing. So fixed cost, which obviously is 120,000, plus target profit, again it has to be before tax, 120,000, divided by contribution margin ratio. If you remember, contribution margin ratio just means contribution margin per unit divided by the sales price per unit. So can I say 20 divided by 50, because contribution margin per unit is 20, sales price is 50. So if we solve this now, we should get our answer of, let's see, there we go. So this means we need to earn $600,000 in sales to to make the target profit of $84,000 after taxes. There you go. So that's all the discussion you will ever need about target profit. Like either it's like a very easy question, there's not even a tax consideration, then you directly apply the formula, right? You don't have to convert the target profit into before tax because there's no such thing as tax in that question. But even if there's tax involved, I hope you can see it's very easy. You just have to do one extra step to convert the after tax profit into before tax profit, so you can apply the formulas in the usual manner. So I'll see you in the next video. Now let's talk about margin of safety. So to explain what that means, so obviously we calculate how much is our break even to know the minimum point, and then we sell, obviously at least try to sell more than that. So margin of safety basically refers to how much more we sold than the break even. So if the break even is $1,000 and we sold $1,500, that means $500 extra we sold is margin of safety. Now margin of safety can be in units as well. So if your break even is 10,000 units and you actually sold 12,000 units, that means 2,000 units extra you sold is the margin of safety in units. So that's kind of what this refers to. So margin of safety is the above break even units or revenue that you have. Okay. Now within margin of safety, like we said, there are different ways the question can be asked. So margin of safety can be in units, Margin of safety can be in dollars, just like target profit and break even, right? Safety in dollars. And then there's the last thing, which is a margin of safety ratio. So let's discuss what all of these three things tell us. I think you already might have all of the idea, but it's still good thing to talk about this. So margin of safety, like we said, unit means how much more you're selling than the break even. So we'll do actual sales minus break even sales. Of course, when we are talking about units, we're talking about sales units here. So let me also write that here just to be clear. We're doing actual sales units minus the break even sales units. And just to make something clear, sometimes actual data is not given, budgeted data is given. Budgeted means our estimated planned data for that accounting period. Then you select the budgeted data, budgeted sales minus the break even sales, just to keep that clear. Margin of safety in dollars, similarly, we'll say actual sales dollars minus break even in dollars, and I hope by now you don't know by dollars we mean revenue, right? How much dollar revenue you are generating. So of course, again, if actual sales dollar is not provided in the question, you'll use the budgeted sales revenue, which of course has to be provided at least for you to be able to solve these types of questions. And the last one we said is margin of safety ratio. So this basically tells you in ratio terms how much of the current year sales or actual sales are in terms of our margin of safety in terms of a percentage, right? So for example, let me write the formula so I can explain it a bit in a detailed way. So formula will be actual sales. It can, by the way, if it's units, use units in the entire formula. If it's dollars, use dollars in the entire formula. You'll get the same answer. So actual sales units minus break even sales units divided by actual sales units. So again, this basically tells you in percentage terms how much of this year's sales are our margin of safety, like how much percentage we sold more. So basically, yeah, different ways to find like margin of safety in units, dollars, and percentage, which is called a ratio. Let's talk about multi-product break even. So far, whatever we learned was when a company sells one single unit, or rather one single product of anything. So for example, if a company sells, let's say, only one kind of calculators at obviously the same price, then you don't need what we are going to learn now. However, now we are going to learn if the company is selling multiple different products at different price levels, how do you find the break even point, right? How much of each product I need to sell to break even, because it's so much more complicated now. Because of course, now I have to figure out how much of this product I should sell, how much of that product I should sell, and so on. So that's what we mean by multi-product break even. Again, if you're selling a single product, you don't have other products with other prices, you don't need this topic, and you only need this topic when you're selling more than one product at different, of course, prices. So that's when this kind of calculation becomes absolutely necessary. Now, before teaching you how to do multi-product break even, I always like to write down the steps, because when you follow steps, life is extremely easy. So you'll see what I mean by that, because people think this is a very complicated topic. It's not. It's just like if you follow the steps, you will be good. So I hope once you see me do the steps, and you'll realize, okay, I just need to know the steps. There's nothing else. So let's get to the steps. Step 1 is determine the sales mix. I will explain what everything is, by the way. Don't worry about that. Step 2, calculate the contribution margin per unit of each product. Step 3, calculate the weighted average contribution margin per unit. And step 4 is apply the break even in units formula if you're doing units, or dollars formula if you're doing dollars, but you can also apply units formula and then convert to dollars like very easily if you remember times by sales price. So that's not a problem. Apply the break even units formula, and once you do that, last step, multiply the break even units with sales mix of each product to find that product's break even units, or dollars, of course. Okay, So let me explain what these steps actually mean. First one is determine the sales mix. Now you have to understand that it's literally impossible for you to know the break even in a multi-product scenario if you don't have a predetermined sales mix. For example, if you don't have this idea of 30% of my sales need to be this product, 40% of my sales need to be this product, that's kind of what we mean by sales mix. Means how much of each product you want to sell, like what is the ratio of each product you want to sell, in the total 100%. So that's kind of sales mix is. If you're a student, it will always be given in the question, of course, there's nothing to worry about there. Second step is to find the contribution margin per unit of each product, which you already know is sales price of the product times minus variable cost of the product. Third step is to calculate the weighted average contribution margin per unit. For this, I will give you a formula here. Let me mention the formula right here. For weighted average contribution margin, formula will be contribution margin per unit multiplied by sales mix of product A. Let me also write product A here so it's clear what I mean, of product A. So contribution margin per unit of product A times sales mix of product A plus contribution margin per unit of product B times sales mix of product B. Contribution margin per unit of product B times sales mix of product B, and so on. Like if it's a C product, you also do contribution margin of product C times sales mix of product C and D. Like you just keep going. If you're a student, you'll get like 2-3 products, but if you're doing it for real life, you might have like 7 products. So you can just keep applying the same formula to the end. Okay. Then we apply the break-even unit formula, which is the same as what we learned. It's the fixed cost divided by, in this case, weighted average contribution margin per unit, not the contribution margin per unit, because now we are not doing one product. It cannot be just contribution margin of one product. And then multiply the break-even by sales mix of each product. So let's solve a question. I think in that case, you'll see like exactly what I mean by everything, in case something wasn't clear. So in the coming video, that's exactly what we're going to do. All right. This is the moment we have been waiting for. Now we have the question here. So let me show you how to solve the question with the steps. Again, if you don't use the steps, like then you will be confused, like which information should I care about, which information I shouldn't care about. If you know the steps, you know exactly what you're looking for. First, I need this, then I need that, and so on. So life is easy. So I will ask you to pause the video and read the question, and we will get started together. So let's assume that you've read the question. So this is what I recommend always to keep things clean. Put the products in the columns. So we are doing product A and product B. Now, what is the first step we learned? Is to calculate the calculate the sales mix. I don't know why I'm mixing my words. Calculate the sales mix of each product, right? So sales mix is how much percentage sales you want each product to be from the total 100%. So there's an easy way to do this, which is, if you notice, they're telling you sales mix is for every 3 units in product A, we will be selling 2 units of product B. So that's kind of what the sales mix is, but this is not in percentages. How do you convert that into percentage? Pretty simple. You divide the units of the product, which is A, in this case 3, by the combined units we are going to sell to get the 5. So this means out of every 5 units we sell, 3 units have to be for product A. So if I get the answer, okay, again, Excel is doing its own thing. Let me tell Excel this is not a date value. So this will be 3/5. There you go. 0.6, which we can also say 60%. And of course, if you do the other one, 2/5, you will get 40%, which you can call 0.4. Sorry, what's happening here? Oh, this is, yeah, MacBook. Okay. So for product B, we will do obviously the other 40%, which has to be the product B. If you want, you can even calculate it. You can do 2/5. You get the 0.4. Now, to make it look better, you don't have to do this. You can make this a percentage, It looks a little bit cleaner, I guess. So step 1 finished. We calculated the sales mix of each product. Step 2, calculate the contribution margin per unit of each product. So here we'll do contribution margin per unit of each product. For product A, contribution margin per unit will be selling price minus variable cost. So 40 minus 24, it's 16. For product B, however, it will be 30 minus 18, so 12. Step 2 finished. Now step 3, calculate the weighted average contribution margin per unit, which obviously has this formula. So we literally just apply the formula. So let's do the weighted average. And here we're not doing it for each product separately. It's combined. So let me just merge this cells. So now we're doing weighted average contribution margin per unit. Formula was contribution margin of product A. So 1 second, equals, okay. Formula was contribution margin of product A times sales mix of product A plus contribution margin of product B times sales mix of product B. And that's it. We literally just found out what is the weighted average contribution margin per unit. So that was our step number 3. Now step number 4 is to apply the break-even units formula. So let's do that. Break-even units formula, which was fixed cost divided by contribution margin per unit. So let me just write the formula for you, just so you can recall this. Fixed cost divided by contribution margin per unit. But because this is multi-product, instead of saying contribution margin per unit, we'll say weighted average contribution margin per unit. So weighted average contribution margin per unit. So if we want to solve this, what is the fixed cost? It's 84,000. Divide by what is the weighted average contribution margin per unit, of course, which is 14.4. So if you solve this, you will get the number of units you need to sell to break even, not each product separately, the total units you will get, right? Of course. So if I divide this by this, now we have found out the total break-even units, which is the first requirement. Calculate the break-even point in total units for the sales mix, in total, not like separate it out. So that was step number 4, to find the total units to break even. Now step number 5, to like separate these out, like how much of the total is product A and how much of the total is product B. So step is saying multiply the break-even units with sales mix of each product to find that product's break-even units. So to find in each individual break-even, we will do the total units times the sales mix, like we said in the step, right? Here, the total units times the sales mix. Done. And that's it. We literally now know that company would sell 3,500 units of product A and 2,333.33, which you can round up all as always. So 2,334 units of product B to break even. I hope you saw that when you do step by step, life is easy. You know what you're looking for. The question can be this type of question. Question can be the longest question. It will be solved the same way. As long as you know the steps, you will be fine. Now we are going to start the decision making in managerial accounting. So there are so many decisions that you can make in managerial accounting, like whether to make this product or that product, whether to make the some of the parts in-house or to outsource it, means buy it from some external supply, and so much more. So before starting that, we do need to get familiar with some of the basics. So first of all, we need to talk about what do we mean by a relevant cost. Now, there are many ways teachers teach this, but I don't really agree with most of the ways that it's taught. Because the problem is, like, if you take shortcuts and you say this is a relevant cost, always think this is a relevant cost, those are good things to know, which I'll also tell you. However, you should know exactly what a relevant cost is as well. So, what is a relevant cost? So, I would say relevant cost is any cost that is a cash cost, future cost, and it is incremental to the decision that you are making. Means it depends on a decision that you're going to make. So what do I mean by cash cost? Means it has to have some money value. Like if it's like a let's say emotional cost, of course that's not we cannot categorize that in accounting. So it has to be cash cost, means it has to have some financial value. It has to be a future cost, means it hasn't happened yet, I'm going to incur it in the future. And it has to be incremental to decision, means it has to be up to you whether you want to make this decision and spend the money, or make this decision and not spend that money. So you are deciding whether to spend that cost or not. So that's kind of what we mean by relevant cost. Now let me try to make it a little bit easier process for you. So we already talked about variable costs and fixed costs. So I'm going to put this into that framework so it's a bit easier for you to understand what I mean by these. So first, let's talk about variable cost. We know that variable cost is any cost that happens for every unit you produce, right? So for the level of production. So in this case, when I'm saying variable cost, usually we can say variable cost would be relevant because if I do make the product, I have to spend the money. If I don't make the product, I wouldn't be spending the money. So for the most of the variable costs, these are relevant. Almost all of the variable costs are relevant. Now, again, the idea is variable cost by definition happens for everything you do. It doesn't have to always be there. If you don't do that thing, you don't have to spend this money. So that's kind of why variable costs are almost always relevant. Why I'm saying almost, because there are some specific things that are not relevant, but that's not at the moment. That shouldn't be your concern. Then fixed cost. Now, this is where students make a lot of mistakes when we talk about the fixed costs. Now, fixed costs, of course, by definition, we know fixed costs are costs that do not change with the level of production. However, you have to divide the fixed cost into two different parts. There's something called avoidable fixed cost. Let me give you an example. Uh, how about let me first write the other one, which I think you know is unavoidable, then I'll give you an example for both of those. Okay. So let me give you example of avoidable fixed costs. Like how can a fixed cost be avoidable? Very simple. Let's say you have a shop, you know, and it's under like one huge building. In the shop, you have three sections. So you have, let's say, the uh, clothing section, you have the shoe section, and then you have, let's say, um, we can pick so many things. Let's say you have some random, let's say, um, hat section. I don't know, like if that's the correct division, but let's assume that, you know. So we have a clothing section. Of course, hats will be there, but let's assume this. We have a clothing section. You have the shoe section, and then you have the hat section. But rather, let's just make it equipment section. Let's just say, right? So you can buy sports gear and everything. So that's a gear section, let's say. Again, just to make sure, because we talked about two things. So we have the clothing section, then we have the shoes section, and then we have the gear section where you can buy a lot of equipment and a lot of items. Okay, so now let's assume each of those sections has their own supervisor. And of course, supervisor would be on a salary. So we know salary is a fixed cost. So this area, let's say clothing section, has their own supervisor. The shoe section has their own supervisor, and the gear section has their own supervisor. So if I get rid of the gearing section, I also wouldn't need the supervisor either, right? So that fixed cost of the salary of the supervisor is a avoidable fixed cost because it's in my decision whether I want to spend this money or not. Because if I keep having that department or rather section, I would have to keep paying the supervisor the salary. And if I remove this section, I wouldn't have to pay that salary at all. So that's kind of what we mean by avoidable fixed costs. So yes, now hopefully you know fixed costs are sometimes avoidable. So please remember, avoidable fixed costs are relevant because they depend on your decision. You can decide whether you want to spend this money or not. So you have to take that into consideration. However, unavoidable fixed costs are irrelevant, means ignore them in any decision. Don't consider them at all. Doesn't matter if it's $1,000 or $1,000,000. Ignore the unavoidable fixed cost because doesn't matter if you make this decision or that decision, you'll have to pay that money anyways. So why care about that? You want to make the best decision for things you can control. It's like the game of chess. Like even if you're in a worse position, like you're losing, you have to make the best decision in that case. You cannot consider, okay, I cannot win, so let me just do whatever I can. No, no, no. Even if you're in a worse position, you have to make the best decision to lose the least amount of money. So that's also where these decisions actually help you quite a bit, because this is not always about making more money, because usually they are, but sometimes you're in a horrible position. You can lose $1,000 or $500 on a decision. So you obviously will go with the losing $500. So I hope this is clear. And let me just define a couple of more terms and then we will start the actual decisions. So there's something called opportunity cost we have to define here. Now, for those of you who have already learned economics, you would know what opportunity cost is. Opportunity cost is basically to do something, you're giving up doing something else, right? So that's what opportunity cost is. For example, when you're taking this course, the opportunity cost might be you watching a Netflix movie or something, you know? So you're giving up watching Netflix movie to watching this course. So to be precise, because in accounting we have to be number oriented, you have to say the best next alternative given up. Means if you obviously we are going to assume we're going to choose the best possible scenario. The second best scenario you're giving up is your opportunity cost to be able to do the best thing. Opportunity cost is all not always there, but sometimes it is. Means to make this product, I have to give up making that product, and that's opportunity cost. We'll talk about that. Don't worry about that at the moment. I just needed to tell you what opportunity cost is. It's the best next alternative given up. And the last thing we need to talk about before we move on to the actual solving is sunk cost. Now, if I want to put it technically correctly, I would say sunk cost is any past cost or any cost that has already been incurred. Means it is not up to you that you want to incur this cost or not. By the way, incur means it will happen. So, but for our purposes, even if you just think of sunk cost as any past cost, that works. I mean, like that doesn't really affect us that much. But just to let you know, the full definition will be past cost or any cost that has already been incurred. Means, for example, if you have already entered into a legal agreement to rent the building for 3 months, now that 3 months worth of rent is a sunk cost because you've already incurred that, like you cannot now change that. You are already entered into agreement, you have to pay that money regardless of what you decide. So that's why please remember sunk costs are always irrelevant cost. Irrelevant, always. Because if I cannot control something, why should I worry that about that in my decision making? It will happen this way or that way. I should just make the best decision for the factors I do control. Similarly, opportunity cost is something we are giving up, means we are losing out on to make one decision over the other. This is of course always relevant. You always have to take into consideration. If I do this, what am I losing out on? So that's your opportunity cost. So I hope all of that's clear. I try to, summarize it as much as possible without like compromise. First decision we are going to talk about is the make or buy decision. Very common decision for students and also in real life that you got to make. Now, what is make or buy decision? It's also called outsourcing decision. Means whether you want to make some component in-house, means yourself, or you want to buy it from an external supplier. So how do we decide that? What goes into that decision? So let's learn all about that. So what I recommend always is just make a format first, like get used to a format, and then just you plug in the numbers and life is easy that way. So let me show you the format. So format is on one column, write the things that you'll have to do in the make area, and on the other column, write the things that you'll have to do for the buy thing, like if you go for the buy option. So we're basically trying to calculate the cost, like how much money will I have to spend to make the product, how much money will I be spending to buy the product. Whichever is cheaper, that's one I'm going to go with, assuming the quality is the same. Now in managerial accounting, we always have the assumption, right? When you're making decisions, quality is remaining the same. Of course, in real life, like quality is different, then you don't do this. Like you have to make more considerations to make. But in this case, assuming quality is the same, this is actually how you make this decision. So first you have to write the direct material. Of course, it's going to go in the MEC column because only when you make the product you need to buy material. Direct labor, again, of course, again, if you're making the product, then you need to incur the direct labor. Variable overhead, similar approach. But fixed overhead, we have to be careful if you remember from our previous video. Fixed overhead, we only have to take the avoidable ones because avoidable are the only relevant ones. Unavoidable ones I have to pay even if I don't make any product or if I buy all of the product, doesn't really matter which decision I'm making, right? So avo avoidable is the only thing you should care about in decision making. Unavoidable, ignore it, think of it as it doesn't even exist. Okay. So that's the make column items that you will probably see in the outsourcing decision. And in the buy column, I just have to pay the money to buy the product. So can I say just the purchase price to buy all of the units I need of the component, right? And that's it. Now, if you do the total, This will give you the total cost. And of course, you will choose the option which is cheaper. Is it cheaper to make something in-house? Means this is lower, or is it cheaper to buy from some external supplier, or this is lower? So let me just mention, we will choose to do the option that is cheaper. Again, assuming quality same, that's always assumption managerial accounting. So that's kind of the format. Now we are going to solve a real question to show you how it actually applies. Let's solve this question. So again, pause the video and read the question first, and we'll get started together. So let's get started. Now, before solving anything, I will literally copy the format that we already learned about the make or buy decision. So let's copy this and we will paste it here. There we go. Okay. So in the question, obviously we have a choice. Either we can make the part X. Let me zoom in for you. Either we can make the part X ourselves, right? Or we can buy the part X from an external supplier at 12 per unit. So we know a couple of facts here, like what we're talking about. And if you notice, 60% of the fixed overhead is said to be unavoidable. That means the remaining 40% has to be avoidable, right? So that's the logic. If 60% is unavoidable, that means the remaining has to be avoidable. And then the space used to produce products can rent it out for $8,000 per year. So now that is where the opportunity cost comes into play. So let me explain. So they are telling us in the question that if we decide to keep making the part X, we'll have to spend this much money, material, labor, variable overhead, and fixed overhead. This is per unit, so I'll show you how to convert it into total. And also, uh, we will lose out on renting out this space for $8,000 per year. Because think about it, if I keep making the product in house, I will need that space to keep making the product. So that means this $8,000 has to be considered as opportunity cost. So this gives me an opportunity as well to add another thing to the format, which is, sorry, there we go, which is opportunity cost. Because we said opportunity cost is always relevant if there's any in the question. So opportunity cost, it will go in the make area, because usually in the make or buy decision, if you decide to keep making the product, you lose out on the extra money you can make by renting out that place to someone else. You know what I mean? So in this case, we will add that here as well in our format. We'll say opportunity cost in the make column. Now, obviously, I could have made the question a bit easier, but why don't we just solve the maximum question you encounter, like with the opportunity cost and everything. So let me show you how this format really works. So first of all, I need to write down the direct material I'm using for the product. So if you notice, we are using 5 per unit. And how many units are we supposed to make? 10,000. So 5 times 10,000 will be, so every year, I'm going to be spending $50,000 on material. Similar with labor, 4.50 times 10,000. Similar with variable overhead, 2 times 10,000. And similar with the fixed overhead, but again, we know only 40% is avoidable, since the question is saying 60% is unavoidable. So what I'll do is, I will grab the 40% of per unit number, which is 3.5. And just to let you know, per unit is not actually like per unit, because fixed costs are not dependent on the units. What has happened is, uh, the company has actually divided the total fixed cost by the number of units. That's how they know the per unit. We don't actually spend fixed cost per unit. So with that being said, first let's convert the per unit into 40% and then multiply it by the number of units we are supposed to get it for. And then the opportunity cost, if I keep making the product, of course, if I keep making the product, I will lose out on this space being rented out to someone else for $8,000 per year. So I'm losing out on that rent money that I'm going to make if I didn't make the product and gave the space to someone else to use. There you go. And the purchase price is always just the purchase price usually. So we will have to pay 12 per unit. And how many we need to buy? 10,000. So let's see which is cheaper. So in this case, Okay, so it's cheaper to buy the component from uh, an external supplier. So we will say the company should buy the component from the external supplier. And if you notice, if we buy the component from an external supplier, we are saving out on how much money? $17,000. That's called a financial advantage. Okay. So in making this decision, if from buying it from external supplier, the financial advantage would be $17,000. And that's it. Let's talk about the special order decision now. Now, what is special order decision? So to put it simply, what happens sometimes is, let's say I have a business of selling, let's say, chairs, okay? And I usually charge $30 for the chairs, $30 per chair. Just to repeat that again, I have a business of selling chairs and I usually price it them at $30 per share. But of course, a customer can come up to me and say, okay, I want to buy 10,000 chairs from you, but I'm only willing to pay $19 in price. So now we have to decide whether we want to fulfill that order or not, because uh, they are asking me to sell them the chairs at a lot lower than the market value. That's kind of what the special order is, when you get a bulk order and then you have to give them discount on the price and you have to decide, should I make should I do this order or should I reject the order. Okay, so let me first make the format. As always, I will do in our classes, because formats make life easy. You know what you're looking for in the question. So first of all, to let's say fulfill the order or make the order, as we can call it, will be one column, and the other column will be uh, rather I can even say like this: to cost to make the order and revenue from the order. Now, of course, like if you look at it like at the first glance, it seems like that, of course, I will look at the cost and I'll look at the revenue. If the revenue is more, I will accept the order. But however, we always know we don't need to consider the irrelevant cost. So we have to be very judgmental in that case. So first we'll write direct material, how much material we need to make their product. We need direct labor. We need variable overhead. We need fixed overhead. I hope you remember it, only the avoidable part. But just to let you know, in a special order, you don't usually have fixed overhead avoidable like in the questions. Just to get you aware of that fact. And also opportunity cost. Opportunity cost. So these are things that will have to encounter to make the order. Now you might say, how does opportunity cost make sense here? Think about it. If I want to complete an order for a client, I might have to give up on some other production that I already have, because I already might be at capacity in my production department. So to fulfill this order, I have to give up on existing units, you know. So we will see what that is about. And again, just to make that clear, fixed overhead avoidable is usually not seen in this type of decision, but I'm just writing that in case you get this weird type of question. Okay, and then here it's just revenue from the order, which you'll write there. So of course we'll do the total, and if the revenue is more, that means we should accept the order because it's making us more money than it's losing us, right? So total numbers. So we will accept the order if the total revenue is higher than total cost. And that's it. Now we'll solve a question. Of course, please read the question that we have here and we will get started. So let's talk about the question. The question is saying, we have a company of making coffee mugs, of course, and we normally sell them at $10 per unit. And then we have some cost, like how much it costs us to make the coffee mug. I hope you remember. Material, okay, good. Variable labor, variable overhead is variable, of course. Fixed overhead is given as per unit, but we know it's not a per unit in like nature. It is a total cost that has been divided by their existing units to find the per unit, right? So this fixed overhead is actually the total fixed overhead that the company is paying, but they are just dividing it by the number of units they are producing at the moment. Okay. Then they are saying the company has unused capacity. So unused capacity is like, when you rent out a huge space, so you're only using a part of the space. That means the rest of the space that is free, that's your unused capacity. Means I can do the work on that space without having to rent out another building. So here they're saying the company has unused capacity and receives a special order from a client in another country for 3,000 coffee mugs at $6.5 each. The customer will cover shipping and handling, and no additional selling costs are involved. Again, to solve this question, we really just need to know the format. So what I'm going to do is I'm going to copy the format we already learned and see if it can help us make this a special order decision. Okay. So on the left side, we have to write the direct material it will take us to complete the order, because if you notice, cost to make the order and revenue from the order. So cost to make the order, material per unit is 2, and we are supposed to make 3,000 bucks. So 2 times 3,000, $6,000 will be our cost to make the coffee mugs. Then we have direct labor, which is 1.5 times 3,000. So 4,500 is the direct labor. Variable overhead, again, we always know it's also variable. So 1 times uh, 3,000, and then the fixed overhead avoidable. Do we have any avoidable fixed overhead? No, we just have a fixed overhead that we already are paying. We're just dividing by the number of units. So that means in order to do this, let's say complete the order, we don't have any avoidable fixed cost, means we can get rid of any. So this will obviously be 0. Like I said, I think in the previous video as well, that um, fixed overhead avoidable in this type of decisions you don't really get to see. Opportunity cost, are we losing out on some other products by making this order? No, we're using unused capacity, so no opportunity cost. And then revenue from the order, so $6.5 each. So let's see, 6.5 each times 3,000 mugs, 19,500. Now we do the total. If the revenue is more, of course we will accept the order. For some reason, why is it not letting me remove? Oh, there we go. Okay. So this will total into 13,500, and this is totaling into 19,500. So of course, if you notice here, we are making more total revenue than the total cost we have to incur to make the order. So this means we should accept the order. Again, by we mean the company that's making the decision. Accept the order. And also, that's the first requirement they were asking. Should classic company, company accept or reject the order? So we'll say we should accept the order. The second requirement is, what is the net impact on operating income, means profit, if the order is accepted? That's pretty simple. You just look at the difference between the cost and revenue, which is 6,000, right? So the operating income will increase by $6,000 by accepting this order. And we are done. So let's talk about a limiting factor decision. So I've already put everything here just to make the video a little bit shorter, so you don't have to, procrastinate a lot to be able to watch this video. You can see it's a very short video. Okay, so what is the limiting factor decision? Limiting factor decision is when you don't have enough of something as you need to meet your, let's say, production. So for example, if I need 100 pounds of cheese to make all of my pizzas, burgers, and chicken rolls, and I only have 90 pounds of cheese, that means I don't have enough of cheese, right? So cheese is my limiting factor. Limiting factor is only when you don't have enough of what you need until you need it. It's not like, for example, if I need 100 pounds of cheese, I have 101 pounds of cheese. That's a limiting factor. No, because I have more than I need, right? I have more than enough for my production needs. So that's kind of what the limiting factor decision is about when you don't have enough of a one specific factor of production. Now it can also be a labor, by the way. If you need like 5,000 labor hours, but you only have 4,000, that's a limiting factor because you don't have enough to meet your production needs. Okay, So for this type of decision, I always like show these steps to my students because this has worked amazingly, because usually this is considered a little bit harder topic, but when you follow the steps, it is quite a lot easier. So what is the step? Step one, determine the limiting factor, which is going to be very obvious in the question. If you're a student, if you're real life, again, it's going to be very obvious. Step number two is calculate the contribution margin per unit for each product. Again, just sales price minus variable cost. Very easy. We already learned that formula, right? So I hope you're seeing the more you learn in managerial accounting, the more the rest of the topics are becoming easier. You know, you're like seeing similar formulas and things. Okay. In any case, step number three is where you'll see something new. So this is calculating the contribution margin per limiting factor used for each product. Now, because the new thing, I also mentioned a formula, how to find that. But just to let you know what this means for every 1 pound of cheese, in case of cheese, how much contribution margin is the product earning? Because we shouldn't really care about the contribution margin per unit. We should care about the contribution margin we are able to make by using the per unit of limiting factor, because we want to maximize the profit making, right? And then step number four is rank the products according to the contribution margin per limiting factor used. So obviously you might have understood some things that I said here, but there's nothing better than doing a real question. So in the next video, we're going to do exactly that. So let's solve this question of limiting factor. Again, pause the video, read the question, and we will get started together. Now, assuming you have read the question, so you must have realized the machine hours are the limiting factor because we have a limit of 10,000 machine hours per month, and there's no demand limit. So that means we could have made as many as we would have liked, because if there was a demand limit, then we would have to see to meet the demand how many hours do I need. In this question, we don't have a demand limit, means whatever we don't have like unlimited amounts of, that's the limiting factor in this type of question. So why don't I copy the format that I already showed you and show you like that is a great way to solve any limiting factor question. So let me paste the steps. There we go. Okay, so what is the first step? Determine the limiting factor. We know limiting factor is the machine hours. So step one, finished. Step two, calculate the contribution margin per unit of each product. So let's do that. So I will always recommend writing the products into columns like I always do, and beta the other product into the column as well. Okay, so now we have to find the contribution margin per unit of each product. For alpha, the contribution margin per unit would be sales price minus variable cost. So 60 minus 36 would be 24. And for beta, we have 50 minus 30, so 20. Done. Step 2 also finished. So step 3, calculate the contribution margin per limiting factor used for each product. So I already gave a formula for that, how to do that. So contribution margin per limiting factor, in this case per machine hour. So formula is very simple. You divide the contribution margin per unit with the limiting factor used per unit. So let's see how many machine hours we are using per unit. For alpha, 3 hours. So we'll divide this by 3. There we go. That means for every 1 machine hour, alpha is giving us the contribution margin of $8. Okay, similar with beta, we'll divide it by divide its contribution margin per unit by the limiting factor it's using per unit, which is 2 hours. So divide it by 2. So third step also finished. Fourth step, rank the products according to the contribution margin per limiting factor. So if you can see which has a higher contribution margin per machine hour, of course the product beta. So according to the ranking, we will be making product beta first. And if we have, let's say, met the demand of product beta and we have some machine hours left over, we'll use those remaining hours on alpha. But in this question, of course, we don't have a demand limit. So whatever machine hours we have, we'll just keep making the product beta and just keep going. So what was the requirements? Requirements were determine which product should be prioritized. We already know we should be making the beta product and prioritize that to maximize profit, assuming machine hours are only limiting factor. Okay. If speed tech can produce either product, how many units of each should it produce to maximize profit using all of the machine hours? So now we have to determine with 10,000 machine hours, how many units of beta can we make? So the formula is very simple. You divide the total limiting factor by the per unit requirement. So in this case, we'll do total machine hours divided by how much machine hours we need per unit of beta, which is 2 hours. So that means we would be able to make, or we should make, 5,000 units of the product beta. And that's it. That's how you make the limiting factor decision. Just like follow the steps, and I hope you're seeing that's very easy to solve as long as you know the steps. If you don't know the steps, again, as I always say, you just wander around, look for extra information. Should I care about this? Should I care about that? You don't need to do that when you know the steps. You know exactly what you're looking for. So that's it for this video, and I will see you in the next one. Let's talk about budgets. So in accounting, when we say budget, we basically means a plan or a target or a goal for a future. Okay. So budget means a plan, target, or a goal. So what happens is at the start of each year, companies plan like what they want to achieve that year, because that it is very important for everyone in the company to know what they're expected to do. For example, a company will have multiple departments. For example, the sales department, maybe let's say production department. I just want to show you why this is so important to have a budget. It's not just if we know a goal, we will be able to achieve it. That's one thing, right? If you have a target, you can hit the target. If you don't have a target, like what's going to happen? Like it's not good. However, there's another reason to this, to preparing budget, which is always overlooked. So let's say I have a sales department, production department, and procurement department, means the purchase department. Okay. Now, what will happen is, let's say I don't have a budget. Okay. Means I don't have a plan of what I want to sell the next year and everything like that. Now, the problem will be the sales department might be able to sell, let's say, get orders for 2,000 units. For example, sales department might be able to get orders for 2,000 units, means they did very good marketing and everything, and they were able to get this many orders. However, the production the production department only produced 300 units. Why? Because they didn't know the overall goal of the company, how much they want to sell. And procurement department might only have purchased material worth 400 units of product. Means the material that the procurement department purchased can only produce, let's say, 600 units, or in this case I've written 700 units. So this is the main thing about budgets. So budgets have many benefits. One benefit is, of course, you have a direction, right? So you might want to have a 5% improvement over the last year. That's a good thing about budget. Okay, you have improved numbers from the last year. However, also, if you have a budget, every department knows what the overall goal is, and they individually will do their activity in accordance to reach that budget. For example, procurement department, if they were aware that the goal is to sell 2,000 units, they would have bought material for the 2,000 units. Production department, if they were aware of the 2,000 unit selling goal, they would have produced 2,000 units. And the sales department, in this case, they've already sold, got orders for 2,000 units. But let's say they did not have a budget, they would also not really know like what to do. Like, should we do marketing, or should we, like, are we already doing good, and things like that. So that's kind of why we need budgets. And now in the next video, we're going to talk about static budget versus flexible budget. Let's first try to understand what we mean by static budget, and then we'll talk about what is a flexible budget. Now, static budget is a budget that's made at the start of the year. It is actually the budget we just talked about. At the start of the year, you plan out certain things, like how much I want my sales to be and everything else based on those sales units. So that's what static budget is. So this is a budget that is prepared at the start of a year or accounting period, however you want to look at it. Usually the accounting period is in a year. So let's think about it yearly. Now you might say, okay, then what is a flexible budget? So to help you understand the need for flexible budget and what it is, first I want to show you the problem with static budget. Okay, so what will happen is, let's say this was my static budget. For the sake of argument, let's say my sales in the static budget were 1,000 units, and my sales revenue for those 1,000 units was around, let's say, $100,000. Okay, and based on those units, my direct material that I should have spent money uh, equal to would have been worth, let's say, the goal was to spend $30,000 on material, uh, 10,000 on labor, and let's say manufacturing overhead. Okay, let's say 5,000 on the overhead. So let's say this was my goal, right? I wanted to sell 1,000 units, and I wanted to make a sales revenue of $100,000, and my material I wanted to be 30,000, and so on, things like that. Now let's say the year passed. So at the start of the year, I planned out these things. Now let's say the year passed, and we have the actual data. In reality, I was able to sell 800 units, so I made a revenue of 800,000. My material was, let's assume it was 25,000. My labor was 9,000, and my manufacturing overhead was, let's assume, 4,000. Now there's a problem. The problem is, let's compare both of them, right? Let's see where we went wrong and where we did a good job. Okay. So with regarding to sales units, of course, like we did a worse job than we wanted to do. We wanted to sell 1,000 units. However, we are only able to sell 800 of those units. Now, sales revenue, we wanted to make $100,000, but we only managed to make, sorry, this is 80,000, not 800,000. There you go. Sorry. So we only managed to make $80,000 in revenue. So here we are really unhappy. Now, in material, we wanted to spend $30,000 on purchasing material, but we ended up spending less money, $25,000. So on the surface, it looks like a very good thing. Okay, I saved money on material. So the problem is, we did not save money on material because of doing some great negotiation and buying things at lower price. We spend less on material because we produced less units and sold less units. So this is a problem when you're comparing static budget data to the actual data, because they are at different production level. It's like comparing apples to oranges. It doesn't make sense, because all of these numbers are based on 800 units, and all of these units, all of these numbers are based on 1,000 units worth of sale. So they cannot be compared with each other. That's the problem with static budget. When you compare static budget with the actual data, it doesn't give you the right answers. It doesn't really tell you where you went wrong, where you actually did a good job, because every number is dependent on like the units, and if the units are different, of course, everything you should not compare it and find out where you went wrong. That's where the flexible budget comes into play. So let me explain what flexible budget is, and then we'll talk more about it. Flexible budget is a budget that is prepared at the end of the accounting period, or at the end of the year usually, based on actual level of activity. Means, what will happen is, after the year has passed, now the company will produce another budget based on 800 units to see, when selling 800 units, how much money we should have made from sales, how much money we should have spent on materials, how much money we should have spent on labor. And now you can compare the budget, means how much we should have spent on everything based on the units, and the actual, how much we actually spend. Now you might say, um, then how would we make budget at the end of the year? Very simple. We learned standards. Standards are basically how much it should cost us to make one unit. We use the standard data to find the total budgeted data. Budgets are prepared from the standards that we already created at the start of the year. So how it works is, standards are created, then with the standards, we create the budget, and after the budget, of course, the year passes, and then you compare the budgeted data with the actual, but not the static budget. At the end of the year, we'll create a flexible budget based on what actually happened, and then compare the numbers. Means at this production level or at this sales level, what numbers we should have had instead of what we have. So in the next video, I'll show you how why the flexible budget comparison with actual is a lot like that really tells you the problem like in this where you're going wrong and where you're doing a good job. All right, now let me show you let's say if we prepared a flexible budget. So let's create a flexible budget here. Again, for now, I'm assuming numbers. Let's say at 800 units, sorry, 800 units, sales should have been 80,000, which makes sense because if it if at 1,000 units, I wanted to make 100,000 revenue, at 800 units, I would want to make 80,000 in revenue. Now direct material. Now let's think about this. Okay, at 100,000 or rather 1,000 units, we wanted to spend $30,000 worth of material. So let's see how much material we will need for 800 units. So you take the budgeted total material divided by the budgeted units, which is 1,000 to get the per unit that we wanted to happen, times by 800. There we go. So now we know that at 800 units, the direct material spent money should have been 24,000. I hope now you're saying, okay, now we can actually compare the numbers and figure out where we overspent the money or saved the money in real terms rather than just being the change happening because of change in quantity levels. Similar with the labor. So we'll do labor divided by units times 800 to see how much it should have been for 800 units. Now you might say like, why are you dividing the total by the units and to find the per unit? Because we learned that labor is a variable cost. So I can basically divide it by the units and I will find out for every 1 unit how much money am I spending. Now for manufacturing overhead, of course you cannot do the same thing. You have to break it down into variable and fixed overhead, which if you're giving an exam, it will already uh, be into. So let's do that. So let's say this is the variable overhead, and let's say there's a fixed overhead part to this. So this is variable overhead, and then there's a fixed overhead part to this. So let's say fixed overhead was 10,000, and actually we also had 10,000, or rather, let's say actually it was 9,000, and flexible budget will be 10,000. Why? Because when it's a fixed cost, it cannot change with the level of production. So whatever the static budget says, flexible budget says the same thing because it's not based on units. Doesn't matter if I sold less or more. I have to pay the same rent. Let's say rent is a fixed cost, right? So that doesn't change between the two. But however, the variable overhead, we can assume for this many units, it should have been 5,000 divided by 1,000 to get the per unit, and then times by what actually happened. Okay, so there was a fly on my webcam there. Okay, so times by 800. There we go. Now we know the flexible budget means how much money we should have spent or made based on this sales level and what actually happened based on this sales level. And now we can identify where we went wrong. So when making sales revenue, there's no like we didn't go wrong with making sales revenue. We made the amount of revenue we should have made based on 800 units, right? However, for material, we can see we overspent material by $1,000. We should have spent 24,000, but we spent 25. So that means we have $1,000 of variance between the actual data and the budgeted data. And please remember, whenever there's a variance which is not good for us, this is called unfavorable variance. So now, okay, at the end, I'll explain what to do there. For this one, again, we have the same problem. We overspent $1,000 on labor as well. So this will be 1,000 unfavorable variance. Again, we lost $1,000 on labor that we shouldn't have because we should have spent $8,000 on labor. And similarly with the variable overhead, oh, okay, in this case, we don't have any variance, no variance, because what actually happened is what I wanted to happen. However, in the fixed overhead, actual was 9,000. I expected 10,000. So now here we actually saved money. So this is called a favorable variance where it's good for you. The variance was good for you. There we go. And just to give you the title, these are called variances. Variance basically means the difference between actual data and the flexible budget or static budget, depending on what type of variance you're doing. But just to let you know, uh, comparing static budget with actual and finding variances don't tell you anything because the data is skewed based on the units. It's not correct. So in real life, we never compare actual with the static. We compare actual data with the flexible budget. And also even in your exams, in the questions, you'll be supposed to compare actual data with flexible budget and find the variances. And if you can see here, now I know that direct material people spent $1,000 more. So of course I will investigate that and figure out what's the problem. That's about to come in our future classes of the topic variance analysis. And similarly, direct labor, we also need to investigate what went wrong. Why did the HR department, let's say, spend more money than they should have? And for variable overhead, there's nothing there. For fixed overhead, we will also investigate. Now, because the thing is, we don't only investigate when it's bad for us, we also investigate when it's good for us to reward the people who saved us money, to encourage them so next year they do even better job, if not the same job. If you don't encourage them and recognize their contribution, they will not do the save you money there next year. So we want to reward our key employees. And that's it for this video, and we'll continue on the next one. So as you can see in the screen, I have listed down all of the budgets that we prepare at the start of the year to make sure that we know what we want to sell this year, we know how much we need to produce this year, we know how much we need to buy in materials this year, labor, everything. So these are the list of budgets that we prepare at the start of the year. Now, of course, since this is an intermediate managerial accounting course, we will cover like all of the main ones that you'll be asked. You'll not be asked to make the budgeted income statement or the budgeted balance sheet. So except those two and the ending finished goods inventory, except these three, all of these I have shown in this course. So let me explain what this is. Now, master budget is what we call the collection of all of these budgets. So when we say uh, what is the master budget of this company, we are asking what are all of the budget of this company, what they want to sell, what they want to produce, what they want to buy in material and everything else, and so on. So now if you understand that what budgets are prepared at the start of the year, you also need to understand that this sequence is actually important. This is not an arbitrary sequence. I didn't just come up with this sequence because all of the budgets are based on what we are expecting to sell. For example, if I'm expecting to sell 10,000 units, then in accordance with that, I'll prepare the production budget and material purchase budget and the labor budget and overhead budget and everything. So I just want to make it clear this sequence is exactly what you need to follow in the exam questions and everything like that. So just keep that in mind. Now, in the next video, since I'm trying to keep the videos short, in the next video, I'll show you the formats of all of the budgets that you need to know. All right. So in this sheet, obviously this will be in the attached files to this video. So for now, in this explanation, let me show you. So what I've done is I've prepared the formats that you need to know to be able to prepare the budgets, because in the examination, you probably will be required to make these budgets. So it's actually it's pretty simple. On the columns, we always write the months we are trying to make the budget for, because in the exam, you'll either be asked for 2-3 months worth of these budgets. So if you notice, to make sales budget, we just need to write the units sold, again, which will be provided in the question, with the selling price, which will also be provided in the question, and to get the total revenue. All you have to do is know the format. What do I need? Okay, first I need to write the unit sold. Then I need to multiply that by the selling price, and then I get the total revenue that I'm expecting for this year. That's how you get the numbers that we already discussed here. This is how we come up with this number. Like, I want my sales revenue to be $100,000 by preparing this sales budget right here. Now, with from the sales budget, once we know how many units we want to sell, we will start with those units to prepare the production budget. How to make production budget? So we write the budgeted sales units, which is this. Add desired ending inventory means like at the end of the year or at the end of the month. In this case, of course, it's at end of the month. How much inventory we want to have in our stock after selling whatever we wanted to sell, and then you combine them to get total needs, and then you subtract the beginning inventory means how much inventory you already have from previous month, because if you already have some, you don't need to produce all of the extra things you need. And if you subtract that, you get the required production in units. Now the reason I'm going through this fast, because the main thing here is to know the formats. All you have to do is memorize the formats. First I'll write this, then this, then this, then this, then this. If you can do that, you already done 90% of the work. Then you'll just have to solve a couple of questions, get just know like how to find this number, how to find this number. That is pretty easy. Okay. Then we have direct material purchase budget. Again, you'll write units to produce. This you will find from the production budget required production units. So everything is related to the previous thing. It's like very sequential uh, in a sequence. So now here, direct material purchase budget, units to produce, and then we have materials required per unit. So units to produce, how many units we want to make, and here how much material we need to make one unit, and then we multiply them together to get the total material needed for production. But we'll add also how much ending inventory of that material we want to have after like making all of the units we will be making, and then you get the total requirement of material, how much total materials we need, and then you subtract what you already have of those materials in stock, because of course like I will have some leftover from the previous month. And then we have materials to be purchased, because if you subtract the material you already have from the total material you need, you get the extra material you need to purchase on top of that. And then you multiply by cost per unit of material. Now units by unit of material, it basically means like, usually materials are in kilograms or pounds. So here it will be per kilogram. You multiply what is the price of per kilogram of material or per pound of material. So that's what they mean. And then you get the total cost of materials. Similarly, direct labor. Now, if you can see, this is very easy. Units to produce, again, from the production budget, times by direct labor hours per unit to get the total direct labor hours, multiply by direct labor hour per direct labor rate per hour, and then you get direct labor cost. So it's very easy, nothing complicated. All you have to do is first memorize the format. Please don't worry about being able to solve the question. Worry about memorizing the format. This is a mistake that students make all the time. They take every topic, like learn every topic the same way. Not every topic is supposed to be learned the same way. Okay, if you're learning activity-based costing, it makes sense. Solve some questions to understand what's going on. However, when you're doing this topic, you have to know the formats before you can even like think about solving a question. So please memorize the formats first, then go and try to solve a question. Now, in the manufacturing overhead budget, we first write all of the variable overheads, indirect material, indirect labor, variable utilities, and then all of the fixed overhead costs, depreciation, insurance, salaries, and all of those things. We've already talked about that. And after that, we prepare the selling, general, and administrative expense budget. Again, you can see it's just like listing of all of the items. I've tried to make it extensive so you know all of the examples that come under selling and which costs are general and administrative. So the easy trick is administrative means office expenses, and general are like which don't fall into either administrative or selling, general things, and then the cash budget. This I've not copied the format here because first you have to make sure the first six budgets are very good, and cash budget will do separately, because I will also like show you how to solve the cash budget, because I know students have a lot of problems solving a cash budget question. So I'll obviously give you some time, try to memorize all the formats, and I will see you in the next video. So as you can see, now I have put the cash budget format here. Now here also, like other budgets, you have to first make sure that you have understood and memorized this whole format before solving a question. So the format is basically on the columns. Again, we have the month, and we start with the beginning cash balance, how much money we already have before the start of this month. And then we plus cash receipts. I've written some examples of what you'll encounter. Mostly you'll just see collection from sales. This fly is it has been bothering me for a long time. Okay. So anyways, In the cash receipts, we'll add back the collection from sales. Now, collection from sales is not going to be directly given to you. Probably there will be some calculations to be made because they will tell you in terms of policy. Like when you sell 20% of the money you receive in the month of sale, 30% of money you receive in the month following the sale, means the next month, and 50% of the money you'll receive in the second month following the sale, so in the third month. So you have to make sure that first you know the format and then you start solving the question. So formats are essential. First we are going to do that. So beginning cash plus cash receipts, these two things usually, and then minus cash disbursements means cash payments. You can, by the way, you can write cash payments here. That doesn't really affect anything. And then we know we'll have to pay for materials, labors, overhead. And I do want you to know all of these examples. That's why I'm like including the examples, because you want to have an idea. Okay, which different expenses will I encounter? Now you don't have to memorize these, by the way. These are like just you have to look at them. When you're memorizing format, just memorize it this way: beginning cash balance, add all of the cash receipts, means receiving of money, minus all of the cash payments, and then you get the cash surplus or deficit. Means if it's a positive number, that means you have more money than you spent. If you have a deficit, that means you spend more money than you have. And then you do like these things. Ignore these things for now. When we solve a question, I'll show you how to do this part. And then we have the ending cash balance, how much money we have at the end of the month. Now, just to make sure we understand something. Now, the purpose of cash budget, now you might think, okay, why would I need to make a cash budget? Because the companies really want to anticipate the shortages of cash. For example, if we prepare the cash budget for the next 6 months, I will know that in the third month, I will run out of money, means I will go into negative. I will have to pay more money than I have. So what I can do is I can pre-arrange a loan agreement or loan arrangement with the uh, bank. So whenever the month arrives, I can easily get the money because I've already agreed with the bank that I would need the loan in that month. Otherwise, like if I don't do anything and I need money in that month, and then I go to the bank, now I have to wait a couple of days, or maybe I have to. There's some problems that I have to encounter. Like, so we don't want to do that. We want to anticipate the shortages of cash, and then we want to make arrangements for that. And if we have extra cash, and we also can, make plans of what we are going to do with the extra cash we will get in this month. So that's kind of what a cash budget is. Again, memorize the format, and yes, also memorize this part. But because what I'm saying is, when we solve the question, I'll show you how to do this part. Which, by the way, this part is actually not difficult. Just to give you an example, what will happen is your question will tell you the minimum cash balance, let's assume, has to be $20,000 at the end of each month. So what we'll do is, once we find the cash surplus, let's assume 18,000. Now I know that the minimum cash balance I need to have at the end of the month is 20,000. 18,000 is 2,000 short of what I need. So what I'll do is I will borrow additional 2,000, and then my total will become $20,000. So that's kind of what this area is for. And then if I have extra money, let's say in this second month, I have 24,000, then I'll see how much money I owe in loans and I'll pay them back. Let's say 4,000 out of 24,000, and then I'll get back to 20,000 and so on. Like if I don't have to pay loan, I can keep all of the money that I have here. So that's kind of what this is. Obviously, variance analysis. Now, this is the topic that I really love to teach because it's very logical and it really helps you understand like where you're going wrong, which area you're making mistakes in, and so you can obviously correct the mistakes. And you might be surprised to know that we can actually track quite precisely where, like, who messed up, like which person costed us money, or let's say saved us money. Because if you remember, we already covered in the budgets that we, at the end of the year, we compare the actual data with the budgeted data and see the variances. So of course we'll find unfavorable variances and favorable variances. So we need to investigate like what caused this unfavorable variance to happen and what caused this favorable variance to also happen. So let's get started. So first we are going to talk about is direct material variances. Now I want to build your foundation in a very strong way. So when we talk about direct material variances, means I either spend more money or less money on materials than I should have. There are always only two reasons which could have caused it to happen. Either there's a price variance, means we paid more per kilogram or per pound of material, or less per kilogram per pound of material than we should have. That will cause a price variance. And then the second reason can be quantity variance. Now, when we're talking about quantity variance, refers to how much material we actually used. So you might have used more material than we should have. That will also cause a variance in our direct materials data. So now we have to think about it. Okay, price variance. I might have paid more or less than I should have. Who is responsible for that? Of course, the purchase department, right? Procurement department. They are responsible for buying the material, negotiating a good price. So when I see a price variance that is unfavorable, obviously I'll go to my purchase department and ask them, like, why did you pay more than you should have? Then we told you to pay, let's say. Now they can have genuine reasons. They can say, because of inflation, the prices have gone up. And if we think that's a logical explanation, then sure, no worries, right? Happens. However, if you go to the purchase department and they just give you a reason like a reason that doesn't make sense, and like they probably messed up in negotiations, they weren't able to negotiate uh, a fair deal. Now obviously you need to take some actions. Okay, maybe you replace that person who was responsible for negotiating, right? Or take some other measures to correct the mistake for the next year. So that's the purpose. Identifying the mistake is not to punish people particularly, it's to correct so next year we don't make the same mistakes. And this is why when you start a business in first year, businesses lose money, because first you don't know which employees are the efficient employees and which employees are the, let's say, not so helpful employees in your company. So that's one thing. And you're making so many mistakes and other things, that's why in the beginning years you lose money. So the quicker you can do variance analysis and figure out where you're going wrong and where you're doing a good job, the quicker you can start making corrections and start making a profit instead of a loss. Okay, anyways, back to the topic. And so we talked about price variance is the responsibility of the procurement department, and quantity variance is the responsibility of the production department, because they use the material, they put the material into the machine, into the batch, right? So of course, if there's a variance because of quantity, we will go to the production department and ask them, like, why did you use more material if that was the case? If they use less than they should have, means they saved us material, obviously we'll say, like, okay, like a good job, right? How are you able to use less material? Now they might say, this is like where story gets interesting. They might say, because the material was so high quality, we didn't have to use as much as we thought. Now we'll go again to the purchase department and reward them, not the quantity people, because they purchased the good quality material. They were the cause of this variance being favorable, means us saving money. So this is how this works. Um, it's very helpful to do variance analysis to figure out what are the mistakes we are making and what are the good things we are doing. So in this case, I just wanted to give you a formula of how to find the price variance. So price variance formula is standard rate. Let me put it in different ways just to make it easier for you. Let's say standard price minus actual price times actual quantity. Now, what do I mean by standard price, actual price? I will explain all of that. Don't worry about it. Okay. How do you find quantity variance? This is standard quantity minus actual quantity times by standard price. Of course, if you're a student, you will have to memorize the formulas, unless it's open book exam, which usually it's not. So now let me explain, like, what do I mean by price and quantity and all of these things. So I always give this example to my students. So when you go to a shop and you ask for a price, does the shopkeeper tell you the price of one unit of that item or everything combined? Of course, one unit. Like, for example, if I go to a shop and say, what is the price of an iPhone? They will tell me the price of one iPhone, not like assume I need the price of all of the money, all of the iPhones together. So that's kind of what you have to understand by price. When we say price, we mean price per pound or per kilogram, whatever the unit of measure for the material is. So you have to, and you might not realize this. Trust me, this is the biggest mistake people make. They are not able to know how to take the numbers from the question. If you don't understand what we mean by price, means if you don't even know price means price per pound or per kilogram, depending on what the unit of measure is. How will you find it in the question? Because question will tell you the total money you spent and some money here you spend. Like how would you figure it out? What the price is? So price is always price per pound or kilogram. Uh, so hopefully that's clear. However, when we talk about quantity, quantity refers to the total kilograms or total pounds that was used or should have been used. So means total kilograms used. So just to make it clear, price will always mean price per kilogram or pound. Quantity will mean the total kilograms or total pounds that you actually used. Okay. Now, so what's the difference? You might say, like, what's the difference between standard price and the actual price? I think you might have an idea. So let me explain. Standard price means how much price per kilogram we should have paid to purchase the material, how much per kilogram we should have paid. Actual price means how much price per kilogram we actually paid. Similarly, standard quantity means how much total kilograms of material, again, it can be pounds, kilograms, but I'll use kilograms because that's most of the world. Total kilograms we should have used because it's the standard, right? And actual quantity means how much total kilograms we actually used. So now now we're going to obviously solve a question. So I can show you how to pick these numbers from a question and the strategy to solve the direct material variance question. So I have a question here for you. Please pause the video, read the question, and then we'll get started. Okay. I'm going to assume now that you've read the question. So I'm going to propose a strategy of solving variance questions. Now, before using any formulas or trying to figure out anything, first make sure that you first find out what each of the four things are. What are the four things we need in the formulas? We need SP, AP, SQ, AQ. SP means how much price per kilogram we should have paid. Let's see. Standard cost per unit of material 4 per kilogram. So we should have paid 4. Now AP is how much we actually paid per kilogram 4.2. SQ is how much total kilograms we should have used. Now if you notice in this question, we have been given standard quantity of material allowed per unit of output. So for every unit we are making, we need 2 kilograms, not the total. This is why people get confused. They will just take this in the standard quantity. This is not the standard quantity. This is standard quantity to make 1 unit of whatever product you're making. But we know that standard quantity means the total kilograms we should have used. So let's think about it. How many units did we produce? 1000. For 1000 units, I would need 2 kilogram per unit. So that means for 1000 units, I am allowed to use 2000 kilograms. This is how you find the standard quantity. So I hope you saw why it's very important to know what quantity means, what price means, because your teacher can give you many different formations of what, like how everything looks. So you cannot just trust the name, okay, standard price, and that means this is my standard price. No, like if you notice here, standard quantity, but it's not standard quantity. This is standard quantity per unit of output. And we know we don't need that standard quantity. We need the standard quantity where we have the total kilograms or pounds in pound question used. Okay, now actual quantity, what did we actually use? 2100 kilograms, if you can see right there. And now since we have picked the right data, and assuming if you already also know the formulas, you will always get the right answer. So let's copy the formulas down and solve them. Just I want to show you like it's a variance analysis is extremely easy as long as you try to invest sometimes into remembering price means price per kilogram, quantity means the total kilograms used. Okay, using formulas is not difficult for anyone. Every student almost uses the correct formulas. They always get the numbers wrong. That's the problem. So let's apply the formula. So in this case, what is the standard price? It will be 4 minus actual price. It will be 4.2 times by actual quantity, which will be 2100 kilograms. If I press enter, see what happens. Negative 420. Please remember, if you get a negative answer, this means it is an unfavorable variance. I'm writing U to indicate unfavorable. So now we know that price variance is 420 unfavorable means the purchase department lost us $420 more than we wanted them to spend. They spent like more extra $420. Now if I do the quantity variance formula, what is SQ? There we go. So let me do it this way, equals, okay, SQ minus AQ times by SP. Again, I'm getting a negative 400 answer this time instead of 420. That means the quantity people means the production people also lost us $400 money. So that means overall, when it comes to direct material, in total we lost $820. So that means the total material variance will be 820 unfavorable. And now we also know, like out of 820, purchase department costed us 420, and quantity department costed us, or let's say production department costed us $400. So that's how you solve the question and the logic behind our solving. So I hope it's clear, and you can obviously do this question again and again until you are able to solve it, and then you move on to the next videos and continue on. Let's talk about direct labor variances. So direct labor variance. Now, direct labor variances are very similar to direct material variances, except the terminology. We use the different terms to um, explain different things. So, for example, I can show you a very easy way to understand direct labor variances. So, for direct material variances, we learned these two formulas and their meanings. So I will just want to show you, like, if you don't really have to memorize two different sets of formulas and things like that, you can just understand that the formulas are literally the same, except we are just changing the terminology. We are just adding some jargon on top of it. So in materials, we say price variance because that makes sense. What is the price per kilogram? But for labor, because we are trying to find price in hours, we say rate variance. So that means the term price changes to rate. Similar in the formula, SP will become SR, AP will become AR, AQ, we'll talk about that in a moment, and SP here also become SR. There you go. Now, let's talk about quantity variance. In labor, we don't say quantity, we say efficiency. Like obviously, if you use less hours, you are more efficient. If you use more hours, you're less efficient. So here, this is actually called efficiency variance. So there we go. Now, in labor, we don't say quantity, we say hours. So instead of saying quantity here, we'll say actual hours. Similarly here, instead of saying standard quantity, standard hours, and actual quantity will convert into actual hours. Again, keep in mind, they still literally mean the same thing. Quantity means the total hours, instead of total kilograms. Price means price per hour instead of the price per kilogram. We're just changing the terminology. We're just changing the name price to rate, quantity to hours. That's all we're doing. Now here, when I'm writing the meanings, because I'm very sure that these meanings will be helpful for you. So let's change that. So standard price, let's convert it to standard rate, means how much price per hour we should have paid. Okay. So obviously I can call it rate. Let me call it rate. There we go. And the actual price will be converted into actual rate. This will be how much rate per hour we actually paid. So see, it's similar to labor. It's just like we're changing the terminology. I hope you notice that. Standard quantity will be converted into standard hours. Since labor, we don't say quantity, we say hours. It means not total kilograms, it means total hours we should have used. And AQ means actual hours. This is total hours we actually used. So that's all about the formulas of the labor variance. And now in the next video, we'll do a question. So I have a question here for you. Please again pause the video as always and read the question, and then we'll get started. Okay. Now, if you notice, obviously we have been given the data, we have been given the standards, and we have been given the actual data. And the requirement is to find the rate variance, means price variance, and efficiency variance means quantity variance, right? Just changing the terms. Okay. So again, we'll adopt the strategy that we have been doing. Find the four things that we need in the formulas. What are the four things? S, R, A, R, S, H, A, H. So here will be S, R, A, R, S, H, A, H. Okay. So let's first find standard rate. Again, remember the meaning. Standard rate means how much rate per hour we should have paid. So per hour, we should have standard hours per chair. We don't need that. Standard labor rate is 18 per hour. That's what we're looking for. Per hour rate we should have paid. Okay. Actual rate. How much per hour we actually paid. So in this question, it's not told to us like how much we paid per hour. But if you think about a little bit, it's quite easy to find it because we have been given the total money we spent and the total hours we worked. So if I divide them, I get the per hour rate, right? So the total money I spent is 19,425 divided by total hours that I paid that money is 150, or so rather 1050. Okay. So that means per hour I actually paid $18.5. That's all you have to do. If your concepts are clear, you will know what you're looking for. There wouldn't be any complications. Okay. Standard hours. Now, what does standard hour means? Standard hour means how much total hours we should have used, not per unit, not something else. Total in for making everything we made, how many hours we were allowed to use. So let's see. We were allowed to use 2 hours per chair. How many chairs did we make? 500. So 2 per chair times 500. In total, we should have used 1,000 hours. Now, how many hours did we actually ended up using? That is 1,050 hours. There we go. So once you found the four things, now applying formula is always easy. Everybody gets that right? So let me copy the formulas and so we can see what the variances are and we can finish the question. So SR, I'll plug the number in, 18. AR, 18.5. AH, 1,050. And here for efficiency, FH, 1,000. AH, 1,050. And SR, 18. So now if we solve them, let's see what we get. So here we'll do equals. There we go. And here we'll do equals. There we go. Now again, we are getting negative answer. That means both of these variants are unfavorable. This is also unfavorable. That means the rate variance means the people who are supposed to negotiate the per hour price, means HR department, costed us $525 more than they should have. And the efficiency variance, the production department, they used more hours and costed us $900 more because of that. So in total, we can say in labor, we lost how much money? 1,425. This is called the total direct labor variance. So in total, we lost this much money because of labor, inefficiencies. So total direct labor variance. Now for material, if we go back here, so we did price variance, quantity variance, and then we did the total. Because total, of course, has to be how much money I lost here, how much money I lost or saved there, combine the two. In total, how much money did I actually lose or saved? So that's it for the labor variance. I hope everything's clear. It should be, because we are learning in a very conceptual approach, very easy. Everything is being understood to the like point. Like there's no such thing as like try to solve some question and figure out what everything is. No, we just look at the question and we know what you're looking for and we solve it. That's it. So that's it for this one. And of course, we'll continue on in the next videos. Let's talk about variable overhead variances. So of course, we know that there are three manufacturing costs that can be broken down into four. We have direct material, we already learned that. Direct labor, we already learned that. And overheads. But the problem is, in overhead, we have the variable part of the overhead and fixed part. So we have to actually calculate the variances for the variable overhead and fixed overhead separately. So in this video, we are going to learn about variable overhead variances. Now, the good thing for you is the formulas are exactly the same as labor. So if I can literally just copy the formulas and paste them here, I will have the formulas for the variable overhead variances. However, instead of calling this a rate variance, we just call it spending variance. Everything else is the same, formulas are same, um, uh, like efficiency name is also same, but only difference that you'll find is the rate. Please remember, hours are hours. It doesn't matter if you're solving variable overhead variances or direct labor variances. Hours are like how many hours you use. That doesn't change. Rate does change because for labor, rate means how much you're paying per hour of labor. For variable overhead, rate means how much variable overhead money you are paying for every hour the work is being done. For example, variable overhead can be electricity, right? How much electricity you're using per hour of labor. A variable overhead can be any other thing that obviously, uh, let's say indirect labor. We have indirect labor based on wages. So every hour they work, they clean the factory, we have to pay them. So that's kind of what variable overhead rate means. How much variable overhead money we are spending per hour of labor. So rate is only difference. Hours are similar to direct labor hours. That doesn't really change. So now we're going to obviously solve a question. So you can see everything's pretty straightforward. Now, of course, we have a question here, but I also want to make the change in the writing. Of course, we explained everything what standard rate in variable overhead means. So let me change it. So standard rate means how much rate per hour we should have paid. If I want to make it more precise, I'll say how much variable overhead rate, let's say variable overhead we should have, we should have spent per hour, we should have per hour of labor. That's what standard rate here means. Standard rate means how much variable overhead we should have spent per hour of labor. Actual rate means the same thing, but how much we actually did. So how much variable overhead we actually spend per hour of labor. Simple way to put it. And obviously, everything hours are the same because we said labor and variable overhead are used based on the same hours. Hours don't really change at all. So look at the question and we will get started. Okay. So again, solving the question, we have our strategy. Find the four things: SR, AR, SH, AH. Standard rate, what does that mean? That means how much variable overhead rate we should have spent per hour of labor. So let's see. So standard labor hours per unit, we don't need that. Standard variable overhead rate 4.5 per labor hour means we're spending $4.5 in variable overhead for every labor hour we are working. So 4.5 actual rate, how much variable overhead we actually spend for every labor hour. So again, we have not been given the rate, so we have to find it. Simple. It's the total variable overhead divided by the total labor hours. So 17,390 divided by 3,700. There we go. Now standard hours. Standard hours again means the total hours we should have worked. So we know per unit labor hours is 3 because we know variable overhead and labor direct labor have the same hours, you know. So 3 times how many units did we produce? 1200. So what I did is I took the hours we should have spent per unit with how many units I've actually produced to see how much I should have used for that level of production. 3,600 hours is standard hours. Actual hours, we already can see 3,700 right there. Now, one thing I will say here, whenever you're getting close answers like SR, is close, H is close, that is, means you probably are solving it correctly. You know, when you get like very different answers, like SH is very different than AH, probably you made a mistake in the exam, you know. So just be on the lookout for that. Now we literally just solve the formulas. I will just copy them and we'll plug in the numbers. There we go. So first we write standard rate. Standard rate is of course 4.5. Actual rate 4.7. AH, which is 3700. We'll solve that. And then this one, SH, which is 3600, minus AH, which is 3700, times SR, which is 4.5. There we go. If I solve this, we will get 740. And if I solve this, we will get 450. So that means in this question also both are unfavorable. And that's how you solve it. Of course, if the answer was positive, that will mean it's favorable, it's good for us. But in this case, it's unfavorable, it's not good for us. If we do the total, this will give us the total variable overhead variance. So this is called the total variable overhead variance. So that's all there is to the variable overheads. Simple, again, just easy to know the formulas. The difficult part, or let's say the complicated part, is to know what everything means, which is not actually that difficult. It's just people don't consider this part, understanding what these four things mean, as important. So they don't spend as much time on this as solving questions. You don't really have to solve questions. First, understand this well, solve a couple of questions. If you're able to find the things you're looking for, you're good to go. Now we have the last category, which is called fixed overhead variances. Now, in fixed overhead, you just have to know two different variances. So there's something called fixed overhead spending variance. Now, formula for the fixed overhead are a bit different than the other things we've learned so far. So just to let you know that upfront, so you are careful in the fixed overheads. So we have a fixed overhead spending variance. This basically means budgeted fixed overhead minus actual fixed overhead. And then there's a second one called fixed overhead volume variance. Now for formula for this would be applied fixed overhead minus budgeted fixed overhead. Okay. So just to make it clear, budgeted fixed overhead is the fixed overhead you estimate at the start of the year, means how much fixed overhead you want there to be in this year. So this is always provided in the questions, or let's say usually provided in the question. Budgeted fixed overhead is the planned overhead, let's say as a planned overhead that was estimated for the year. This is a planned overhead. When we're saying actual overhead is how much you actually had in overheads, right? How much actually you paid factory rent, factory salaries, and everything like that. So actual actual fixed overhead. This is overhead, or rather fixed overhead that was actually incurred. And the last one is the applied fixed overhead. This is where people go wrong. So please remember, like we have learned in the previous classes, applied always means the rate, means how much per unit or whatever the rate in standard is given, times by how much you actually worked. For example, if the rate is in per hour, you multiply by how many hours you actually worked, like we've been doing in the previous topics, you know, in traditional costing, activity based costing. So you multiply the rate with how much you actually used of the cost driver. Same here, if the rate is in per hour, you multiply it by the hours we actually used. If the rate is in machine hours, you multiply machine hours we actually used. If the rate is in labor cost, you multiply it by the labor cost we actually incurred. So it's actually quite easy. So applied fixed overhead will be the rate, or rather I should say fixed overhead rate multiplied by allocation base actually used, not budgeted, actually used. So that's the applied overhead formula. Again, if you've been doing the previous topics well, you would be aware of this formula. This is nothing new for us. So now obviously we're going to solve the question so I can see you and show you how to apply all of this. All right. So read the question and we will get started. There we go. So now I'm going to assume you've read the question. So in this type of formula, we need three things, right? Because in the formulas, we just have three things. So we have to find the budgeted fixed overhead, actual fixed overhead, and applied fixed overhead. So that's all we're going to do. So first we're going to find budgeted fixed overhead, then actual fixed overhead, then applied fixed overhead. So what is the budgeted fixed overhead? There you go, 60,000. Actual fixed overhead, 63,500. Now the only one that which people have trouble with, which is the applied fixed overhead. Like how would we find that? Again, we know the formula. Whatever the rate is based on times by how much of that allocation base you actually used. So we have been given standard fixed overhead rate per unit is 15. So that means we have been given the rate per unit, means allocation base is the units. So we multiply 15 by how many units we actually produced, which is 4,200. And that's how you find the three things. Like this is what people think is very hard. It's actually not hard. It's just like you, if you know what you're looking for, you'll always get the right answers. Like there's no complications in these questions. So let's do the fixed overhead. Why don't I just copy the questions as previous videos and we will just solve this right there. Okay. So first let's solve the spending variance. So budgeted fixed overhead minus actual. So budgeted is 60,000 minus actual is 63,500. So that means the variance in the spending is 3,500 unfavorable, which makes sense, of course. Like I spent more overhead than I was expecting to. So it's a bad thing. It's not a good thing. In the fixed overhead volume variance, applied minus budgeted. So applied is 63,000 minus budgeted, which is 60,000. So we have a 3,000 favorable variance. And that's basically how you calculate the fixed overhead variances. Now, basically, if you do the total, you'll find the total fixed overhead variance, which in this case is 500 unfavorable. That means overall we lost extra $500 in the fixed overheads than we wanted to spend. So that's basically it. Again, how you find the variances, pretty easy. All you have to do is just understand how to find the things in the question. That's all. Nothing else is a problem in these questions. So question problem is students find is they're not able to know what each of these things means. That's all. So that's it for this video. We are going to talk about absorption costing versus variable costing. So let me mention both of those. So we're going to talk about variable costing and absorption costing. Now, you might be wondering, okay, we've already learned the job costing and activity-based costing. What is the difference between those things we learned and what we're learning right now? So, job costing and activity-based costing are a way to trace the cost to the product that you're manufacturing to find out how much it costed us to make the product. However, variable costing and absorption costing are ways to report the data that we have. We are not calculating the cost of the product, even though that is part of variable costing, absorption costing, but rather more importantly, they are going to report the data in different ways. So just to give you a basic introduction, so the idea under variable costing is that when we're talking about manufacturing cost, we should only consider the variable manufacturing cost, because the fixed manufacturing cost, even though it is a manufacturing cost like factory rent, it is not actually happening directly because of the product. Even if I don't make the product, I still have to pay the factory rent. It's fixed. You know what I mean? So that's kind of what variable costing is about. So it says only consider direct material, direct labor, and the variable part of the overheads as the manufacturing cost. Means fixed overheads are not considered manufacturing cost under variable costing. However, under absorption costing, it is the idea we already know about. So it's the direct material. So let me just copy and paste this, I guess. But also it considers fixed overheads as manufacturing cost, which of course is the correct idea. You know, if you're talking about generally, of course, this is the correct way of thinking. However, when you're a company and internally you need to like judge the manager's performance and see like how well we did, you only want to look at the costs that are in your control. That means variable manufacturing costs, because those are the costs that you can control. You know, you can decide to pay less per kilogram of material, you can decide to use less amount of material and have less wastage, and similar with labor, you can be more efficient with labor. So these are things where you can control. Fixed overhead amount that you have to pay, you cannot really control. You have to pay what you have to pay. So that's kind of what the we have the two different costings. We have the variable costing and absorption costing. Again, remember what we just talked about is the idea of manufacturing cost under these two different methods. Under variable costing, the idea is only the variable manufacturing cost should be considered as manufacturing cost of the product, and absorption costing idea is all of the manufacturing cost, including the fixed overhead, should be considered part of the manufacturing. So when you're talking about variable costing and absorption costing, in this topic, you're supposed to prepare income statement based on either variable costing or absorption costing. So that's exactly what we're going to do. I'm going to give you the format of variable costing income statement in this video, and in the next video, I'll give you the format of absorption costing income statement. So let's do the variable costing income statement. This is also called contribution margin income statement. So the format is very simple. Uh, so format is sales revenue, whatever the number might be, minus all of the variable costs. So if you take the sales revenue and subtract all of the variable costs you incurred for the period, you'll get something called contribution margin. That's what contribution margin means. It means sales revenue minus the variable cost. Once you get the contribution margin, you're going to subtract the fixed cost, all of the fixed costs. Doesn't matter manufacturing or non-manufacturing. You're going to subtract it in this place. And if you do that, you'll find your operating profit. And that's the format you need to know about variable costing income statement, because obviously when you're learning this topic, you're supposed to know how to make the income statement. So we'll solve a question after I show you both of the formats. We'll solve a question of variable costing and absorption costing, so you have a better idea of how to solve the formats. But for now, if you can take some time and memorize this format, like I guess it's pretty easy, right? Please do so, because later on when you solve the questions, you should try to solve it from memory rather than looking at the format. Now I'm going to show you the absorption costing income statement format. If you have learned financial accounting before this, you would already be familiar with this format. So here we also start with the sales revenue. Let me zoom in a bit. There you go. However, we don't subtract all of the variable costs. Here we subtract all of the cost of goods sold. Means how much it costed us to make the product we sold or buy the product we sold. But since we're learning managerial accounting, you'll get a manufacturing situation. So cost of goods sold will be how much it costed you to make the product that you now sold. So if you subtract both of them together, you'll get gross profit. And then you subtract all of your operating expenses to get operating profit. And that's the format you need to know for absorption costing income statement. Now, let me put this side by side to the variable costing so you can see the differences. So let's put it there. And let's make it. Let me just remove this extra name so like everything can fit harmoniously. There we go. So if you notice, the format, both of formats have the 5 things, right? However, in variable costing, we're differentiating the variable costs from the fixed costs. In absorption costing income statement, we're separating the manufacturing cost, means how much it costed me to make the product, from the operating costs of the business, like the office related costs, which are non-manufacturing costs. So just to make that clear again, in variable costing, we are differentiating cost based on variable and fixed. In absorption costing, we're differentiating costs based on manufacturing and non-manufacturing. So I hope the format is clear. Now, obviously, we're going to solve a question and see how all of this knowledge actually comes into solving. I have a question here for you. Please pause the video, read the question, and obviously then we'll start solving. Okay. So obviously the requirement is preparing the income statement using absorption costing and preparing the income statement using variable costing. So what I'm going to do is I'm going to copy the formats that we already prepared and just fill in the numbers. So you can see like it's all about knowing the format, except like obviously when you're filling in the numbers, you need to know where to take which data from. That is one of the problems students have in this topic. Like what should I consider for this? What should I consider for that? And solve. Okay, in any case, let's decrease the size of this. Okay, so first we need to calculate the sales revenue. So let's see, they're telling us we sold 8,000 units at 50 price per unit. So sales revenue will be, it was 50 per unit. Okay, so 50 times 8,000, which is pretty simple. And the revenue will be the same in both methods, by the way. I shouldn't solve side by side, but at the same time, but it's always the same number. Revenues are not different between the two methods. So why not, I guess. Now we have to minus the variable cost, all of the variable cost, not just manufacturing. So let me give some space here so we can like list down all of the variable costs. So what is the first variable cost we have? Of course, when we are selling the product, you have to account for the variable manufacturing costs. So we will say here, variable manufacturing costs. The calculation will be the direct material per unit, which is 10, direct labor per unit, which is 8, and variable manufacturing overhead per unit, which is 2. So these are the variable manufacturing cost times by the units we sold, which is 8,000. And if you solve this, this will be the variable manufacturing cost. However, we also have variable selling and administrative expenses per unit. So we also have to mention that since all of the variable costs go under the variable cost, variable selling and administrative expenses. So here we will do, let me give the width, there we go. So here we'll do 3 times 8,000, of course, because 8,000 units are what we sold. And now, if we don't have any other variable cost, let's see, no, we don't have any other variable cost. We can do the total of the variable cost and then subtract from the revenue to get contribution margin. So why don't I do that? Let's find the total variable cost, which should be quite easy. There we go. Now we subtract the sales revenue from the variable cost to see what is our contribution margin. And once we get that, now we can subtract our fixed costs. So in this question, we have fixed manufacturing overhead as well as the fixed selling and administrative expense. So let's do that. So first, let's do the fixed manufacturing overhead, which is 60,000. Okay. And then also subtract the fixed selling and administrative expense. Yes, selling and administrative expense, which obviously amounts to, in this case, 20,000. Now, if I subtract all of the fixed cost from my contribution margin, I should get my operating profit. Done. So this is how you calculate the operating profit based on variable costing. And now we're going to do absorption costing. If you notice, we already have the sales revenue written down since it's the same between both methods. However, other things will be very productive for us to see how to solve these parts. So when it comes to absorption costing, you have to be very careful about the fixed manufacturing overhead, because we know that here we also consider the fixed manufacturing overhead as the manufacturing cost. So when I'm doing the cost of goods sold, means how much it costed me to make the products that I sold, I have to take into consideration how much it costed me in fixed overhead to make the products I sold. So to do this, this will, I think, will be very good practice for us. So to find the manufacturing cost, not just the variable manufacturing, all of the very manufacturing. So we can literally do Uh, or since I already know the variable manufacturing, I can just combine the variable plus the fixed portion, right? Since we already found the variable manufacturing cost in the variable costing, so I can do this number plus how much of the fixed overhead I used in the products I sold. So if you notice here, the total fixed manufacturing overhead is 60,000, but we use this to produce 10,000 units. So first we have to divide it by 10,000 units to see the per unit money we spent, and then we times by 8,000 to see how much went into the products that we sold. So, so it will be 60,000 divided by, uh, it was 10,000, right? Okay. So 10,000 times 8,000. So that will be the formula. Again, just to explain, this was the variable manufacturing cost. So direct material, direct labor, variable overhead. And this is how you calculate the fixed overhead that you used in the manufacturing of the products that you sold. Now we just subtract both of them together. We will get the gross profit. And after gross profit, you subtract all of the operating expenses. So in this case, operating expenses we have is the variable selling and administrative and fixed selling and administrative. So variable selling and administrative, which I guess we already calculated here. So why don't I just take from here and save some time? And the fixed selling and administrative, which was 20,000. That means the operating profit under absorption costing will be 148,000. Now, if you notice, the operating profit is different under both of these methods. So that's what we are going to talk about now in the coming video to see like why is there a difference. So just to give you a hint, it's because of the fixed overhead. In one case, we are considering all of the fixed manufacturing overhead and subtracting it. In the other case, we are only considering the fixed overhead that was applied because of 8,000 units, not all of it, because 2,000 remaining units we did not sell. So that's the only difference. I guess I can just do it in this video. Let's do it in this video. Okay. So that's what the third requirement is. Reconcile the differences in net operating income between the two methods. To means like show what caused the difference in the profits. So reconciliation of operating profit under both methods. So first we will write the variable costing operating profit. It doesn't, by the way, the sequence doesn't matter. You can just first write the absorption costing operating profit and do the same thing I will do. So variable costing operating profit, which was 136,000. And now we realize, okay, in variable costing, I subtracted all of the manufacturing overheads. However, in the absorption costing, I only subtracted manufacturing overheads for 8,000 units. That means the difference is 2,000 units worth of manufacturing overhead. So if I add that back in the variable costing, I should get the same answer as the absorption costing, because again, we subtracted all of the overhead for 10,000 units here and 8,000 units here. So if I add back 2,000 units worth of overhead, so it wasn't subtracted, it will give me the same answer as the absorption costing profit. So let's see if that works. So add fixed overhead uh, for 2,000 units that were unsold. So it will be 60,000, which was the total overhead, divided by 10,000 to get the per unit, and then times by 2,000 to see how much of that related to 2,000 units. And if I add this and this together, because we are removing the effect of that extra number, we should get absorption costing, absorption costing, operating profit. And just to confirm, yes, that is correct. So that is what reconciliation means. So you can prove that your concepts are clear. You know why the profit difference is arising in this situation.